Ladies and gentlemen, please put our hands together to welcome our honorable guest. Ladies and gentlemen, good morning. Welcome to the Global Financial Leaders Investment Summit 2025. I'm Teresa Lin from the Hong Kong Monetary Authority, and I'll be your host for today. Before we begin today's program, allow me to introduce the following honorable guests joining us at the summit today. They are the Chief Executive of the Hong Kong Special Administrative Region of the People's Republic of China, Mr. John Lee. And the Executive Deputy Director of the Hong Kong and Macau Affairs Office of the State Council, Mr. Xu Qifeng. Director of the Liaison Office of the Central People's Government in the Hong Kong SAR, Minister Zhou Ji. And the Financial Secretary of the Hong Kong SAR, Mr. Po Chan. Welcome again. Every November, we gather here in Hong Kong as a global financial community to talk about the current state and future of finance. This year, we've again curated a very rich agenda that will take us through the key developments, trends, challenges, and opportunities that could have far-reaching implications for the global economies and the financial market. As set out in the theme of this year's summit, we hope that today's dialogue will give us lots of insights and inspirations as we track through this shifting terrain. 再次欢迎大家. Welcome again, everyone. Let us begin. Let's begin today's program with welcome remarks by Mr. Eddie Yu, Hong Kong Monetary Authority's Chief Executive. Eddie, please.
Chief Executive, Executive Deputy Director Xu Qifeng, Minister Zhou Ji, Deputy Governor Liu Lei, Vice Minister Zhou Liang, Vice Chairman Li Ming, Acting Commissioner Li Yongsheng, Financial Secretary. Good morning and a very warm welcome to the HKMA's 4th Global Financial Leaders Investment Summit. And I'm really glad to say that the summit this year is finally spared from the typhoon, unlike the last few years. Many of you will recall that the summit actually started off as a one-off exit COVID event that was held in the middle of a very big typhoon. Little did we know that it will evolve into an annual tradition with more than 100 global CEOs joining us year after year, and we are truly grateful for your support. Our theme this year is Trekking Through Shifting Terrain. It draws inspirations from the numerous beautiful hiking trails crisscrossing Hong Kong. In fact, Hong Kong is home to one of the world's toughest trail races, a race so iconic and memorable that inspired the creation of an award-winning documentary. And the perseverance required to complete this brutal challenge perfectly showcases the can-do spirit of Hong Kong people. And those of you who joined our dinner last night, who have seen the edited documentary and the runners, should have felt it. Hiking aside, the financial terrain that we've been trekking through in the past year has also been rather challenging. The macro backdrop has been shifting, marked by slowing growth, rising government debt, and also a prolonged period of trade and geoeconomic uncertainties. Meanwhile, AI and crypto are bringing new dimensions or even challenges to traditional financial intermediation, and the role of non-banks continue to grow, while the ties between banks and non-banks are also deepening, which are developments that some believe are getting more concerning. Yet, somewhat at odds with this uncertain outlook, we've also been observing a continuous climb in asset prices for some time. For financial leaders and regulators, this raises the question, are markets building up for an abrupt correction, just like what we saw in April, or are we just over-worried? None of us can answer these questions with certainty, and that, however, does not justify inaction. Just like hiking demands an eye on the weather and a change of terrain, financial leaders need to be watchful of market shift and plan ahead. And this has very much been the approach that the HKMA takes, being the guardian of Hong Kong's monetary and financial stability. And this is also why we are all here today, to share and learn from each other and to leverage the collective wisdom to help us track our way through the uncharted territories ahead. With the gathering of so many bright minds and unparalleled experience in the room, I'm sure that we all have something useful to bring home from today's summit. Thank you very much.
Thank you, Eddie, for setting the scene for us. Next, I'd like to welcome the Chief Executive of the Hong Kong Special Administrative Region of the People's Republic of China, Mr. John Lee, on stage to deliver the keynote for us. Chief Executive, please.
Honorable Executive Deputy Director Xu Qifeng, Honorable Director Zhao Ji, Honorable Deputy Governor Lu Lei of the People's Bank of China, Honorable Vice Minister Zhou Liang of the National Financial Regulatory Administration, Honorable Vice Chairman Li Ming of the China Securities Regulation Commission, Honorable Acting Commissioner Li Yongsheng of the Ministry of Foreign Affairs of the PRC in Hong Kong SAR, Mr. Eddie Yu, distinguished guests, ladies and gentlemen, good morning and welcome to Hong Kong to the Global Financial Leaders Investment Summit, now in its 4th annual edition. I still remember that when I addressed the inaugural summit in 2022, a time when the world was emerging from the COVID-19 pandemic, I said the event showed that Hong Kong was on stage again. 3 years on, I'm proud to say that Hong Kong now shines on the global stage, radiating prosperity, confidence, and much needed reassurance. Don't just take my word for it. In September, the Canadian-based Fraser Institute ranked Hong Kong as the freest economy in the world. That's #1 in economic freedom. Also, this September, the Swiss-based International Institute for Management Development, in its World Talent Ranking, ranked Hong Kong 4th in the world and 1st in Asia, our highest ever ranking in the report. Still, with the IMD, Hong Kong finished 3rd in its World Competitiveness Yearbook, this year up 2 places from 2024. And in the Global Financial Centers Index, We placed third in the world, just 1 point back of London and 2 behind New York. Ladies and gentlemen, you are here, some 300 global financial leaders from all over the world, including more than 100 group chairpersons and CEOs, to see Hong Kong for yourselves. You are here too to get the latest financial and investment insights and intelligence from the summit's high-profile speakers and to network with a world of like-minded aficionados of finance. I'm sure you enjoyed last night's welcome dinner at the Hong Kong Palace Museum, where East meets West in a dazzling integration of modern architecture and traditional Chinese cultural elements. Because more than global rankings, Hong Kong also dazzles with cultural diversity. The theme of the 2025 summit, Tracking Through Shifting Terrain, resonates with yet another facet of Hong Kong's inimitable appeal. I'm talking about our remarkable network of prized hiking trails. You can explore them in our 25 country parks, covering about 40% of Hong Kong total land area, waiting for you and your hiking boots. Trekking through trails, marked and unmarked, shares a good many similarities with what financial leaders, all of you here today, face every day in this time of geopolitical uncertainty, market volatility, and headlong technological advances. I'm here to tell you that there's firm footing in Hong Kong, your steadfast partner. We offer certainty and clarity, together with confidence and opportunity for global investors and businesses seeking to diversify their assets and minimize risks. For the next few minutes, allow me to put a spotlight on two elements of compelling interest to you all here, our financial markets and fintech. Hong Kong's financial markets remain vibrant despite the uncertain global outlook. Our stock market has soared over 30% year to date, while average daily turnover has exceeded $32 billion, nearly double that of last year. In the first 10 months of this year, Hong Kong recorded 80 initial public offerings, raising over $26 billion. And that, I'm pleased to say, puts us #1 in IPO fundraising worldwide. To maintain the momentum, we're pressing ahead with reforms to listing regime, enabling the financing of overseas companies, enhancing trading and risk management efficiency, and promoting the trading of stocks in renminbi. In September, we published a roadmap for the development of fixed income and currency markets. It's designed to attract primary market issuance, boost secondary market liquidity, expand our offshore renminbi business, and develop next-generation infrastructure. It will offer global investors more choices as they seek to allocate assets and help companies raise funds in these multiple times. Meanwhile, Hong Kong is poised to become the world's largest cross-boundary wealth management center in the next few years. To fast-track that development, we are enhancing the preferential tax regimes for funds, single-family offices, and carried interests to make the sector all the more attractive. We are also pursuing net growth areas, including building an international gold trading market. That rise on the substantial global demand for gold as a hedging investment and also a reserve asset. Then there's financial technology. Blockchain and artificial intelligence are reshaping financial markets at an unprecedented pace. They can bring tangible benefits to financial markets and the real economy, enhancing efficiency and reducing transaction costs. Hong Kong is home to more than 1,200 fintech companies. In September's Global Financial Centers Index, we ranked #1 globally in fintech. No surprise to the 37,000 professionals here from more than 100 economies for Hong Kong FinTech Week and the Start Me Up Hong Kong Festival, which opened yesterday. It is, by the way, the 10th anniversary editions of both international gatherings, drawing in fintech and startup enthusiasts to our enterprising city. In June, we published our second policy statement on digital asset development, a refreshed take on our determination to establish Hong Kong as a global hub for digital assets. We are working with regulators on a future-proof regulatory regime key to enabling the healthy and sustainable development of digital assets in Hong Kong. Licensing aside, our sandboxes allow promising fintech applications to be tested in controlled environments. Among them, Project Ensemble explores the tokenization of assets and the development of common industry standards. The Monetary Authority will promote live transactions of tokenized assets, exploring tokenization's potential in digital trade and other areas. Tracking through shifting terrain is not a recommended solitary behavior for companies or for economies. It's why I'm grateful for the continuing support of market leaders, all of you here today. Hong Kong was built on reaching out, on seeking international partnerships and mutual opportunities. Our unique one country, two systems framework enables that, allowing Hong Kong to reach out to a world of prospects while maintaining unparalleled access to China, our country. I've just returned this Saturday from Korea for the APEC Economic Leaders Meeting. There, I had the pleasure of representing Hong Kong, China, a full and separate member of APEC, and meeting and working with leaders from a world of economies to advance the important cause of open trade and multilateralism. Later today, I will depart for Shanghai to attend the China International Import Expo. Also joining the expo this occasion will be 380 Hong Kong companies, which will promote their products and services and put a bright spotlight on Hong Kong brand. The Shanghai trip will also mark the first major promotional event by the newly established Go Global Task Force. This task force will make it easy for mainland companies to find foreign markets and global capital as the world looks to our country for its quality products and services. In finance, the term leverage refers to the use of borrowed funds for future investments. Here in Hong Kong, we leverage more than funds. We leverage our financial prowess for the benefit of investors, economies, and importantly, humanity. I'm pleased to note that the Asian Infrastructure Investment Bank, AIIB, announced just yesterday that it will set up an office in Hong Kong. The AIIB is a multilateral development bank that supports developing countries in infrastructure improvements. As a committee member of the AIIB, Hong Kong will do all we can to support its establishment of an office here. That includes leveraging our vibrant capital markets, world-class professional services, and diversified products. We will also help the AIIB in project financing, bond issuance, investment management, and much more. These examples, ladies and gentlemen, are more than business missions, meeting dignitaries and commercial operations. They are one country, two systems hard at work. They are shining examples of how the principle, how Hong Kong helps connect the world with the Chinese market. My thanks to the Hong Kong Monetary Authority, this summit's main organizer, and to each and every one of you for the invaluable presence. When you are here, do make the most of all that Hong Kong has to offer. That includes the scenic hiking trails I've mentioned. That also includes this very hotel we are at, which I'm glad to say has just been crowned #1 in the world's 50 best hotels ranking. And our many Michelin-starred restaurants and award-winning bars, one of which came first in the world's 50 best bars last month, recognized as the world's best bar. Asia's best, world's best, all here for you to experience. To eat, drink, sleep, and spend. Spend some good time in it, some good money in it. On that note, I wish you all a rewarding summit, an enjoyable stay in Hong Kong, and the best of business and investment in the coming year. Thank you.
Thank you, Chief Executive Mr. Lee. It is well known that Hong Kong is a major gateway to the Chinese mainland. Today, we're honored to have Mr. He Lifeng, Vice Premier of the State Council of the People's Republic of China, to deliver an opening keynote for us through video. Let us now welcome Mr. He.
尊敬的各位嘉宾、女士们、先生们、朋友们，第4届香港国际
Ladies and gentlemen, distinguished guests, ladies and gentlemen, dear friends, I'm very pleased to attend the 4th Global Financial Leader Investment Summit. Entrusted by Premier Li Qiang on behalf of the State Council, I extend my warm congratulations to this summit. The Chairman Xi Jinping has always cared deeply about the development of Hong Kong, emphasizing the practice of one country, two systems, which has entered a new stage. He has expressed great expectations for Hong Kong to focus on economic development, striving for new brilliance. We are very pleased to see that Hong Kong has earnestly implemented the Chairman's instructions. With the support of central government, Hong Kong's economy and livelihood have greatly improved. Since this year, we have seen a great economic and social development. In the first half of the year, Hong Kong's GDP grew by 3.9% year-on-year, with a faster growth rate than the same period of last year. Residents' income continued to increase. We have seen stable employment, harmonious society, and a high sense of fulfillment and happiness as well as security by the general public. Hong Kong's financial industries maintain smooth operations. The offshore RMB market developed steadily. We have seen a great performance for the capital market. Hong Kong's Hang Seng Index growth and IPO fundraising ranked the top in the world. We have seen the competitiveness and attractiveness of Hong Kong's financial market. We have again proved one country, two systems has strong vitality, that Hong Kong has a solid foundation for long-term prosperity and stability, and its status as an IFC will continue to be strengthened. Ladies and gentlemen, dear friends, last month, the 5th plenary session of the 20th Central Committee of the Communist Party was successfully held in Beijing. And we have seen the 15th five-year plan being reviewed and adopted. Looking back at the 14th five-year plan, we have achieved great achievements. Our economic strength, scientific and technological capabilities have achieved new heights. We have seen great progress for the modernization of China. Starting from this year, China's economy continued to make steady progress. We have demonstrated strong resilience and vitality. In the first 3 quarters, the economy grew by 5.2% year-on-year, ranking among the top of the major economies globally. And we are fully equipped and confident of accomplishing the 14th five-year goals and tasks. During the 14th five-year plan period, Hong Kong has given full play to its unique advantages and continue to integrate it into the overall national development. Hong Kong has participated actively in national strategies such as the Belt and Road Initiative and make great contributions to the country's reform and development. And at the same time, Hong Kong has consolidated its own stable development in the process. According to the 15th five-year plan, the central authorities have made important arrangements to support Hong Kong's development. With the launch of the new journey under the 15th five-year plan, Hong Kong will surely embrace new development opportunities with bright prospects ahead. Hong Kong should seize these opportunities and proactively align with the national 15th five-year plan development, strengthen cooperation with the mainland in areas such as the economy and trade, further consolidate and enhance Hong Kong's status as an international financial, shipping, and trade center, and will continue to see Hong Kong to accelerate its development in innovation and technology. Ladies and gentlemen, the world is experiencing changes in an unseen manner, and we're seeing a lot of turbulence and transformation. In September this year, President Xi delivered an important speech at the Shanghai Cooperation Organization meeting, where he solemnly put forward the Global Governance Initiative, sparking strong reactions and broad resonance among international community. The Global Governance Initiative, Global Development Initiative, Global Security Initiative, and Global Civilization Initiative promote the shared values of humanity and provide guidance and impetus for building a fairer and more reasonable global governance system. The summit focuses on complex circumstances such as global trade and financial markets uncertainties and explore ways to prevent risks and pursue new opportunities, which is significant for assessing the current situation, building consensus, and addressing challenges. Governance is an important part. Financial governance is also very important, and it is very important for us to study its framework, and it is also the shared responsibility of the people with wisdom. Hong Kong, as an international IFC, gathers international organizations, talents. It is also a place of Orient culture and Western culture. For years, Hong Kong deeply participated in global trade and financial system. Hong Kong is well equipped to research and complete the global governance. And we hope that Hong Kong will continue to play an active role as the bridge, link, and window for connecting the world, and continue to advance in global governance framework. We hope that Hong Kong will continue to contribute its expertise and experience in maintaining a fair, justified, open, and tolerated international economic orders and help President Xi Jinping to put the global governance initiative into reality. Ladies and gentlemen, we have seen new challenges this year for global economic environment. China attaches great importance to promoting stabilities in global economy and trade. As the second largest economy, China aligns with high standard in international economic rules and trade and continue to deepen economic and trade cooperation with its partners. In the first 3 quarters, China's imports and exports continue to grow by 4% year-on-year, and the exports up by 7.1%, making great contributions to global trade and growth. We firmly believe that global economic and trade activities have its own underlying rules. It's very important for us to deepen greater cooperation among economies, as the interest of all parties is also conducive to a win-win outcome. We should follow this course of rules and needs and continue to communicate with each other based on the principle of equality, respect, and mutual benefit. And we should continue to promote global economic and industrial development. And we will follow the trend of globalization and deepen the institutional opening up and expand high-level open up to the world. We will orderly expand the trade and investment liberalization and facilitation and foster a first-class business environment that's market-oriented and rule of law-based. And together with all parties, we will work to meet the difficulties and challenges that global trade faces, jointly safeguard a healthy and stable international economic order, ensure the stability of global industry and supply chain, promote global economic growth, and bring benefits to people of all countries. Ladies and gentlemen, dear friends, Hong Kong's Global Financial Leader Investments has successfully held 3 terms, serving as a very important platform for deepening international financial exchanges and promoting global financial cooperation. It's also a very good opportunity for international financial institutions to understand Hong Kong's developments, and it is also a very important window for Chinese mainland institutions, and it is also a very good opportunity to enhance dialogue. The guests present here today are all experts in economy and finance. I hope that you can all make full use of this platform and share insights, deepen communication, and exchange on issues of common concern, and constantly increase our consensus and seek win-win cooperation. I hope we can have your continuous support for Hong Kong's development and actively participate in China's reform and modernization. Amidst these uncertainties, we hope that we can inject more stabilities and positive energy into the global economy and financial system. In closing, I would like to wish this summit great success.
Thank you, Mr. He, for the keynote. Over the past 3 investment summits, many participants have told us that this event serves as an important window into the latest economic and financial developments of the Chinese mainland. With that in mind, we're pleased to welcome senior representatives from the Chinese mainland's financial regulators to this session. They'll share insights into China's current economic and financial landscape, as well as policy direction. This session will be moderated by Mr. Eddie Yu and be conducted in Putonghua. You may use the headset in front of you for English simultaneous interpretation, Channel 2. Now let us put our hands together to welcome Mr. Yu, along with our 3 speakers. Mr. Lu Lei, Deputy Governor of the People's Bank of China. Mr. Zhou Liang, Vice Minister of the National Financial Regulatory Administration, and Mr. Li Ming, Vice Chairman of the China Securities Regulatory Commission. 现在把时间交给你 Eddie.
So today we are going to talk about the development of the financial sector in mainland. We have been paying close attention to the changes in the financial situation in mainland China. So we have invited a number of regulators here to share with us what is happening. They also express a lot of support to Hong Kong to enhance and foster our position as an international financial center. So, Mr. Lu, can I first ask you, concerning the fiscal policy launched by the BOC, promoting further connectedness of financial activities between Hong Kong and mainland China, let's invite Mr. Lu to deliver his speech. Mr. John Lee, Mr. Xu, Mr. Zhou Ji, Mr. Yu, Mr. Eddie Yu, good morning. I'm happy to be here to join this event together with so many financial leaders from around the world. Hong Kong is a very important gateway leading us to the rest of the world, and it also attracts a lot of foreign investment to come to mainland China. With the support of the central government and under the leadership of the Hong Kong government, we have achieved very good results in terms of deepening our collaboration. Just now we have heard from Mr. He, our motherland has provided clear direction in terms of supporting Hong Kong. When we are looking at such uncertainties around the world, we see the Chinese economy continuously growing and developing, providing great backing to Hong Kong. As the Central Bank of China, we are dedicated to promoting better roles to be played by Hong Kong alongside greater development of our motherland. We are going to promote the development of Hong Kong as an renminbi center, and I have been asked by my leader to offer some personal thinking concerning recent fiscal policies. We have been launching relaxed monetary policies and measures to support stable growth of our economy. We ensure reasonable growth of our fiscal policy and also provided long-term liquidity. And we have offered very good support to the operations of medium-term loans, and also we are providing support to the physical economy in terms of credit demand being met. And we are launching a number of policies to lower the financing cost for institutions and also for other types of loans in our community to address real needs. And we also optimize our credit structure. We have set up a re-loan mechanism, and we have set up an innovation and technology bond risk-sharing tool at the level of 300 billion renminbi so that we can truly support the retirement life of Chinese people and also support the inclusive economy and green economy. We will spare no effort to the execution of such policies.
In terms of supporting Hong Kong as a financial center, in recent years, we have been dedicated to such efforts. In January this year, Mr. Pan at the Asian Financial Forum talked about 4 major areas of his work and also all the relevant measures. We will continue to deepen the connectedness between Hong Kong and mainland China. For example, we are going to strengthen the setting up of the offshore renminbi center in Hong Kong, and we have been responding to the aspirations in the market so that we can further promote various levels of connectedness, including Bond Connect. And we have also provided a lot of support to mainland and also overseas investors concerning the buyback of bonds, so that this will become a very well-recognized collateral in Hong Kong. We will enhance the efficiency and also the value of daily transactions. And more than 1,100 overseas organizations have already entered the bond market, and the scale of such bonds have reached 3.8 trillion renminbi. By the end of July, we have reached a huge amount of investment cross-boundary, and we have also done a lot in terms of the gold market. And we have already commissioned the operation of the gold reserve in Shanghai stock market. In February this year, we have supported the Hong Kong MA to launch a huge-scale liquidity fund, and we have expanded the use of funds in October so that we can ensure low financing cost in terms of renminbi for many commercial banks. We have already reached a very high level of transaction on this front, and together with the relevant government departments, we have set up in Hong Kong offshore renminbi debt and other product offerings. For the first 9 months in Hong Kong, we have launched central bank debt, which is at the level of 30 billion yuan more compared to last year. So we have launched a number of connectedness measures to promote better connection of services so that we can better serve the 9 cities inside the Greater Bay Area. And we have attracted more people to set up bank accounts and provided a lot of convenience for residents in Hong Kong and Macau to live and also receive education and work in mainland China. SIF has been set up, and we have reached 113 organizations facilitating international trade and investment across the border. And we have also set up e-payment platforms to promote the Greater Bay Area in terms of safe and convenient cross-border payment and transactions. We have been working very closely with many institutions. For example, we have covered many enterprises in Shenzhen. We have offered bank financing to many institutions across the border. We are looking at unprecedented uncertainties and fluctuations around the world. This year, we are talking about trekking forward into unknown and fluctuating terrain. I trust that Hong Kong will continue to play its important role, not just as a very attractive financial center, but also we are going to work together with government departments to render our strongest support to Hong Kong so that we can make contributions to the Greater Bay Area, so that we can have high-quality development, we can facilitate cross-border activities and investments, and improve the overall investment environment. I understand that you are all financial leaders from around the world. We look forward to deepened interactions and exchanges with all of you so that we can all create a better future for Hong Kong as a financial center and create great premium to China as well. I wish this forum or the summit a great success. Thank you, Mr. Lu. Now, let's invite Mr. Zhou Liang to talk about how we can further promote the development of our financial sector and foster Hong Kong's position as an international financial market. Distinguished Chief Executive Lee, Mr. Xu, Mr. Po Chan, Mr. Eddie Yan, distinguished guests, ladies and gentlemen, it is very honored for me to attend the 4th Global Financial Leaders Investment Summit. Mr. Xi Jinping attached great importance to the long-term stability and prosperity of Hong Kong and has made a series of important instructions. And Mr. He Lifeng has already made a speech through the video, and we will continue to implement the instructions accordingly. As we know that the 4th plenary session of the 20th CBC meeting has already summarized the achievement of our country, which includes the important part of the achievements in the Chinese mainland and the financial system here in Hong Kong. I would like to summarize it in 4 aspects. The first one is the high quality development of the the financial industry. As we know that the banking and insurance total asset has exceeded more than 500 billion, and as the world's first biggest banking market and the second insurance market, we have seen great performance. The trustees and insurance asset management companies are managing more than 10 billion. And there are more than 143 of them are the Hong Kong subsidiaries. And we have seen great performance for different indicators for the foreign banks in China. And secondly, we have seen great improvement of the service level. In the past 5 years, we have seen funding of more than 1.3 million provided by the banks. We have seen improvement for the inclusive loans. And we have seen more than 1 trillion yuan of investments that goes into science and technology. And insurance as the buffer for risk, we have seen a claim of more than 9 trillion. And third one is about the stable operations of the financial system. The major indicators of the finance are still very healthy. The non-performing loans for banks is around 1.47%. The profitability of insurance companies have greatly enhanced, and the provisions for risk and capital has exceeded more than 5 billion. And we have seen also the stabilization of our property market, and we have seen great solutions for the local debts. And the fourth one is the continuous consolidation of the IFC positioning of Hong Kong. Hong Kong has
banking industries are from more than 40 countries and regions. And we have seen great penetrations and coverage of insurance. And from the first 10 months of this year, the IPO scale in Hong Kong is ranked #1. And at the same time, Hong Kong is now undertaking more than 75% of the offshore RMB settlement and payment business. And connectivity schemes, including the Shanghai, Shenzhen, Hong Kong Bond Connect, Wealth Management Connect, and other schemes have been greatly integrated into the national development. And we can see that the fourth plenary session of the 20th CPC meeting has already confirmed the 15th five-year plan for the country, which suggests that we need to build the country into a financial powerhouse, and we need to focus on science and green finance, inclusive finance, pension finance, digital finance, etc. We need to make sure that the financial institutions can focus on their specialty and complete the overall governance framework. It is also suggested that Hong Kong and Macau should play its role as an important connector of the world and the Chinese mainland. And Hong Kong's position as an international financial center, shipping center, trade centers should be further enhanced. And the country support Hong Kong to build it into an international science and technology hub. All these targets and requirements have created new opportunities for Hong Kong. As we know, for many years, Hong Kong has been #1 among the international financial centers. In the latest ranking, with Hong Kong's achievements in capital funding mechanism, business environment, financial talents, and other advantage, has become Asia's #1 and global #3 financial center. And with the 15th five-year plan, Belt and Road Initiative, and also the Greater Bay Area's policies, the financial cooperations between the Chinese mainland and Hong Kong will embrace great opportunities and space. For our next step, we will continue to deepen our financial cooperation between Chinese mainland and Hong Kong, and to make sure that Hong Kong can be fully integrated into the national development, and to continue to enhance Hong Kong as an international financial center. First, we need to expand the opening of international finance. We need to benchmark with the international standards and explore in a greater scale and greater scope for the finance openness. And with CEPA framework, we respond actively the demands of the finance industries in Hong Kong and Macau, and continue to open up to the Chinese mainland. And we support the Hong Kong institutions and organizations to come to Chinese mainland to build up a vibrant cooperation and partnership. And we'll continue to deepen the interconnectivity with Hong Kong and the Chinese mainland. Hong Kong as the super connector will continue to play a very important role in terms of insurance. The Chinese insurance companies would be allowed to issue insurance-linked bonds in the Hong Kong markets. And we will also continue to provide more facilitated financial services in the Greater Bay Area. Hong Kong has great advantages in international trade, shipping, logistics, and finance services. There are many cooperation modes that we can explore in the Greater Bay Area. We support the banking and insurance institutes to go global, to help the Chinese companies to reach broader markets. Hong Kong has advantage in the finance, law, insurance, and other professional services. It is a very important support and platform for Chinese companies to go global. And thirdly, we need to focus on the 5 aspects for finance development. We need to strengthen technology, green, inclusive, digital, and pension finance corporations. Hong Kong has an advantage in science and technology, innovation, and IP protection. and it serves as a very good window for strengthening digital currency and electronic payment. We support the Hong Kong institutions to deeply participate in the science and finance practices and digital transformation in China. And we also promote the pension finance in Chinese mainland. And we should enable the green and low carbon transformation and provide Chinese example and experience to the world. We also participate into international finance governance and regulations actively. We need to effectively balance the risks and development, and we will further complete the cooperation mechanism and policy framework between the Chinese mainland and Hong Kong regulators to promote the high quality of the finance industry. We will actively respond to external risks and strengthen the communications in regulation, and financial safety and stability will be safely guarded. For the uncertainties, we will continue to focus on our own business, and with one country, two systems, Hong Kong will convert the national strategies into new impetus for its own development, while servicing the country's financial development. Hong Kong will continue to write its new chapter as a strong international financial center. I wish this summit every success. In closing, thank you. And I believe that the opening up of the SFC is of great interest to you. And now let's welcome Deputy Director Mr. Lee to share with us his remarks. Distinguished Mr. John Lee, Mr. Xu Qifang, Mr. Zhou Ji, Mr. Paul Chen, Mr. Eddie Yue, Mr. Yang Fengyu, distinguished guests, ladies and gentlemen, good morning. I'm very happy to be here to attend the 4th Global Financial Leader Investment Summit. On behalf of CSRC, I would like to send my congratulations to the summit. We are now situated in an unprecedented time, and we are seeing a lot of uncertainties and turbulence for the global economic order and the financial system. This summit themed tracking through shifting terrains is very timely. Mr. He Lifeng has already made a very important speech about how we can accurately master the trend of the financial industry globally. And he has also talked about the strategic deployment of financial measures and how to promote an elevated development of the capital market here in Hong Kong. We will continue to implement the important instructions. China's capital markets was spawned amidst reforms and continued to open up to the world. And no matter what the international situation would be, China will continue to remain open for its capital market, and will respond to the external uncertainties with a coordinated manner. In the 14th five-year plan period, the CSRC continue to implement the deployment and policies of the State Council and the central government, and it is always market-oriented and rule-based. For the market access and rules benchmarking, we have launched a series of very iconic open measures with great achievement. Since 5 years ago, we have opened up the market access. We have cancelled the bonds, securities, and futures foreign holding percentage. And we have applied equitable treatment for foreign institutions in this regard. And we support the investment of the foreign financial institutions coming to China to invest. And we have approved 13 foreign securities, futures, and fund companies with great license, and we have seen great growth for the numbers of foreign securities, bonds, futures companies. We have seen great connectivities for the market, and we have completed the regulatory mechanisms for companies to go listed in other countries. There are more than 269 countries going to another country to go public, and we continue to see the expansion of the connectivity scheme, and we have also provided great convenience for the foreign investors to invest in the A-share market. The holding value is now already reaching 3.4 trillion RMB. Foreign investors have become a great participator for the market, and we have seen greater openness in products. We have the mutual recognitions of funds and the ETF mechanism. We support Hong Kong to launch the first A-share futures products, and these has catered to the needs of the investors in different risk appetite. And we continue to open up the new products for futures and stock options. And now 24 specific products have already allowed foreign investors to participate. And we are opening up our capital market. Hong Kong, with its expertise and advantage in institutions, capital, and talents, has already become a very important bridge that connects Chinese mainland capital and the world. We are very happy to see that since this year, Hong Kong's capital market has already demonstrated a very good upward trend. For CACL, Hengrui Pharmaceutical, and other great enterprises has already gone global through Hong Kong. And competitiveness, influence of Hong Kong as an ISC has continued to be consolidated. This attractiveness continued to grow for foreign investors. And Hong Kong's prosperity means great prosperities for the country. And on the other hand, we have seen the national policies benefiting Hong Kong.
Well, we continue to open up the mainland Chinese capital market, while we continue to develop in a synchronized manner. We can help Hong Kong to foster its position as an international financial market. At the same time, to Chinese economy and high-quality development of mainland enterprises, we are also injecting a lot of energy. Not too long ago, the plenary session has endorsed a number of recommendations, clarifying our next 5-year objective in terms of building the high-quality system. We have already set a very good foundation. We have made proposal in terms of constructing our nation into a strong financial power. We will continue to uphold the spirit of the plenary session. We will control risk and move towards high-quality development. We will deepen the capital market and also complete the mission to continuously open up our market and identify useful measures along the way. We will further enhance cross-boundary facilitation of investment and financing. Last week, actually, we have launched a working plan to optimize investors' system so that we can enhance the efficiency and expand the scope of investment from foreign investors and enrich investment options and provide facilitation and highly efficient measures to further support them, provide more predictability and also clarity to our investors. We'll continue our dialogue so as to expeditiously implement these measures. We will deepen our collaboration with the capital market in Hong Kong. We will enhance efficiency for IPO in Hong Kong. Renminbi stock transaction counters would be included into our framework. We will support the futures market in Hong Kong, enrich the management tools for offshore renminbi initiatives, and help Hong Kong to continuously foster its position as an international financial market. We will create healthy interactions. Thirdly, we will further enhance our regulatory capability and risk aversion capability. We will deepen cross-boundary legal protection and collaboration, including the Hong Kong MA. We will share more information, co-negotiation of policies to prevent risk from crossing the border. At the same time, under the OSCO framework, we will continuously promote the capital markets' fair, just, and inclusive characteristics. Dear guests, dear friends, Chairman Xi has already pointed out, if you work with China, you are working with opportunities. If you trust China, you are believing in your future. Under the 14th Five-Year Plan, we have achieved a growth of 5.5%, and we have provided 35% of stability to the world economy. We have very good pillars of support for the Chinese economy. If you look at our Asia market, they have stabilized and rebounded. This year, major indexes have been improving. Total market cap exceeded 111 trillion renminbi. And our two stock markets, the average daily transaction is about 2 trillion. We welcome more international institutions and long-term capital to come to China to establish your foothold so that we can develop and win together. I have a number of ideas that I would like to share. First of all, it's about investment value. Our policies and initiatives are being implemented so that our overall system continues to be optimized. Our internal tenacity has improved. In the first half, Asia companies' net profit and revenue have grown. For the first 3 quarters, our dividend payout in total reaches 2.1 trillion renminbi. And the fluctuation has eased off. So we should be your preferred destination of investment. The Chinese economy is strong, and it will provide continuously unprecedented investment opportunities to all of you. In terms of our journey on modernization, you should grasp such opportunities to share the premium of our development. In terms of being a contributor, the 14th Five-Year Plan already stipulated that we need to be more inclusive and we need to perform greater functions as a capital market. How do we move with the times? How do we deepen reform measures and innovation so that new businesses, new technologies, new enterprises can receive more inclusive services so as to better serve high-quality growth and development. That is indeed an important topic for all of us. We hope that international organizations can share your experience and wisdom and give us your valuable recommendations. Third, as the stabilizer of the market, stability and safety are very important safeguard for a capital market. At the moment, the international financial market is becoming more fragile with a lot of uncertainty. Different economies are striving to strike their balance, but we continue to see complex challenges. International institutions, we hope that you will come to China to invest and run your business and continue to adhere to our laws and regulations, focus on long-term investment, do well your internal risk assessment and prevention, step up your communication with the regulator and government bodies so as to set up this risk prevention system that is well-rounded and comprehensive. I wish this summit a great success. Thank you. Thank you, Mr. Lee. Thank you so much for your comprehensive sharing. Your speeches are really forward-looking, so let's give them a big hand again. Thank you to all of you. Thank you for your sharing. Please stay on the stage for a group photo. Let's look forward at our official photographer. Please look at the media at the back, towards the left. Thank you very much. Thank you all again. Please be seated off stage.
Short break. Please remain seated while we set the stage for the next session. The Chief Executive, Mr. John Lee, Executive Deputy Director, Mr. Xu Qifang, and Minister Zhou Ji will now leave the venue due to other commitments. Thank you again, Mr. Lee, Mr. Xu, and Mr. Zhou for your time at the summit today. Has been an eventful year. We've witnessed some of the most remarkable shifts in global economies, trade, politics, and diplomacy in peacetime. Are these becoming the new normal? Let us hear from the speakers of our next panel. Please put our hands together to welcome our moderator, Arthur Yoon from the Hong Kong Monetary Authority. And joining him on stage, our panelists, George El-Hedri from HSBC, Bill Ford from General Atlantic, and Com Keller from UBS. Can we also have Com Keller from UBS? Oh, sorry. Bill Ford from General Atlantic, please. Okay.
So we're waiting for one more panelist, Bill Ford. Bill, where are you? So you've heard the developments in China in the previous panel. This panel, we look at it from a slightly different perspective. We look at macro trends. Hopefully, the two panels together will lay the foundation for more in-depth discussions on topical issues for the rest of the morning in the other panels. So if I poll the audience for the major macro trends that really matters for the financial markets today, I think it would be fair for me to say that it come up with a list of the following issues. The first and foremost, I'm sure trade and related supply chain dynamics would come up first in the list. And then I can't use the term green anymore, I think. But it's fair for me to say that decarbonization and sustainability related dynamics would continue to be on the list. And then wealth management is seeing a lot of changes in dynamics as well, so that would also feature on the list. And I don't think that list would be complete without any discussions about AI-related investment recently. And finally, in my recent dialogue with fellow banking supervisors around the globe, the topic of deregulation and simplification keeps coming up. So I think that would be another topic that macro trends that we need to cover in this panel. We have 25 minutes, slightly more than 20 now. See how much grounds we can cover in those 5 areas. So let us talk about the trade and supply chain dynamics first. Let me turn to Bill. Bill, you served on the boards of ByteDance and also the National Committee on U.S.-China Relations. Can you just quickly share with us your take on the trade relations between China and the U.S., given the more recent developments?
Yes, thank you, Arthur, and thanks for having me here. I think we've reached a new and more stable equilibrium in the U.S.-China relationship, as evidenced by the meeting between President Xi and President Trump last week in APEC. And I think despite some of the noise on the surface related to tariffs and some of the exchanges back and forth on trade, I think below the waterline, there was actually a much more constructive engagement, as evidenced by Secretary Besson and some of the Chinese leaders in their 5 meetings during the year. And I think it set the stage for a very constructive meeting where 2 major things were accomplished. One was, fortunately, there was a TikTok agreement, final agreement, and second, a pause in any trade actions for another year. And I think it sets the stage for a much more positive and I think stable relationship between U.S. and China in the next year. So I would say it's on a cyclical upswing, despite some longer-term challenges related to national security and competition and technology.
Yeah, thanks, Bill, for that very comforting remarks. Certainly, dynamics seems to be sort of, at least the temperature seems to be coming down a little bit recently, given the dialogues going on. You mentioned more stable equilibrium. I think equilibrium is one word, stable is another word. I do hope that stability would continue, but given what happened in the past 7 months in the trade fronts, stability seems to be a very scarce sort of commodity to go by. Should we be worried about the stability part of it?
Well, I think we've had a lot of volatility in the relationship going all the way back to the Trump's first term, and really a lot of movement in policy on both sides. But I think there's a recognition that both countries will benefit by a more stable and more predictable environment, and I think that was my takeaway from last week's meeting and some of the build up to it in sort of the lower level meetings between Secretary Besson and everybody else.
Thanks, Bill, for that remarks. Let me turn to George. Supply chain. supply chain uncertainties, definitely there's a very important sort of developments going on in the financial markets as well. Now, HSBC actually coined the terms Asia by Asia, I think, right? So can you share with us your take on that in terms of supply chain dynamics changes?
Thank you, Arthur, and thank you, Eddie, for hosting us, bringing us together today for the next few days. A few observations I'd like to share on trade and supply chains. 5 observations. The first one is just echoing what Bill has said. On the 2nd of April this year, we felt that hell was breaking loose, and by the 31st of October, things seem to have subsided and stabilized, and we acknowledge that. There remain some challenges, but minor compared to what we were bracing for back in April. So this is the first observation. It's a relatively good news story where we stand today. The second observation is that trade has been resilient. Despite the last few quarters' uncertainty, trade has been resilient, and so we observe that 72% of global trade remains on WTO terms. This is down from 80%, but we're still talking high 70, in the 70s. Also, trade volume globally have increased by 2.9%. Again, this is down from 3.5% in 24, but we're still talking growth in global trade. The third observation is that trade has been reconfiguring. And this is exactly where the phrase Asia buys Asia comes in. This is one of the major reconfiguration of global trade, where we've seen effectively Asia starting to be much more engaged with itself through various intra-regional corridors, but also between Asia and the Middle East and other corridors around the world, somewhat taking, if you want, taking more prominence compared to what historically was the summary of global trade being China produces and then sells to the US consumer. That's definitely become much more sophisticated and nuanced today with Asia buying Asia. We believe Asia buys Asia brings about 1.8% additional GDP to Asia. So this is that much more wealth that will be created because of the Asia buys Asia. But this reconfiguration is also not only about the geographic reconfiguration, it's also the content reconfiguration, and where we see now technology and AI goods contribute to about half of the growth in global trade. And we're seeing, of course, outside the trade in goods, trade in services grow at twice the pace of trade in goods. So there are definitely reconfigurations across geographies, content, and the substance that's behind it. The fourth observation, Arthur, I'd like to share is that trade is not only about trade. Trade has become a major driver of foreign direct investment and a major driver for employment. And we've seen that very clearly in ASEAN with Chinese foreign direct investment to build manufacturing capabilities, be it autos in Thailand, be it electronics in Malaysia, be it logistics in Singapore, et cetera, et cetera. Vietnam, Indonesia have been also big beneficiaries. But also places like India and Mexico have been big beneficiaries of these FDI flows. So they bring with them hard currency, they bring with them employment, they bring with them wealth, they bring with them export capabilities. And they partly benefited from low wages in many of these countries, compared now, for instance, to China. But also, the potential of this growth is massive, because when you look at the FDIs from within Asia, specifically China, we remain at substantial, or multiples lower than the FDIs of some of the more mature economies, such as the US, Germany, the UK, Japan, Korea. So there is massive potential for more will have a different role in global trade. The first thing is the US was the consumer of last resort. Anything manufactured on this planet would find buyers in the US if they couldn't find buyers anywhere else. And that probably will not be the case anymore. Or if it is the case, it will come at a price. And that's a base tariff to access the US consumer. And we just need to be factoring this in the future as part of the US being more self-reliant than it has been historically.
Yeah, thanks, George, for those trends. All you've mentioned actually creates a lot of opportunities for the region, the APEC region as a whole. but apart from opportunities, are there any risks that we need to watch out for in those kind of landscape?
So Arthur, definitely creates lots of opportunity. I just take the opportunity to say that we have, on the 9th of October, announced an offer to invest more than $100 billion Hong Kong dollars in Hong Kong with our offer to take private Hang Seng Bank. So hopefully that talks by itself about the conviction we have in the opportunity we see in the space. But if I talk about the risks, there are a number of risks. Certainly, a big risk is the technology disruption. Adopting it is an opportunity. Missing out on it is going to be a major risk. And it still comes with some of its challenges. Adopting blockchain is a major opportunity. We already rolled out tokenized deposits for our customers in Hong Kong and a number of other jurisdictions. We're participating to the e-Hong Kong dollar. We're participating to Project Ensemble for the interoperability of blockchain. All these opportunities are real, but there's still a lot that's happening on the blockchain away from regulated financial services in some of these unregulated stablecoin issuers. And that's a threat because it's an activity we cannot engage in being regulated and living by different standards than some of these issuers. Hong Kong's addressing that through the recent regulation on stablecoins, but obviously it's still a major global challenge. And then the second, I'll mention the second opportunity, challenge, of course, is generative AI and large language models. Opportunity in how we can improve customer experience, productivity, coding, efficiencies, how we can improve fraud detection, and I can go on, simplification of organizations, et cetera, all of which we're dipping into. But it is a challenge because obviously the expertise remains somewhat limited, the compute power remains somewhat challenged, and the use cases and the benefits cases aren't yet proven. We're still trying to prove them.
Thanks, George, for that. Let me put that a question related to what you're saying to put that questions to Bill. So your firm has been investing in China and Asia Pacific emerging markets in particular. What do you see are the more compelling investment opportunities now in this part of the world? And related to that, this part of the world is still soldiering on in terms of sustainability-related investments. GA has been leaning into climate and sustainable infrastructure with your Beyond Net Zero and Actis. Do you still see that as a major sort of trend? And given the current global environment in some of the major markets, are you seeing sort of backpedaling?
Well, there's sort of two questions in there. One related to where are the investment opportunities here in Asia, and the second related to energy transition and climate. And I'd start with the first and just say I think that China still represents an incredible opportunity for new investment related to innovation, entrepreneurship. And there's a new cycle of entrepreneurship, I think, happening in areas like life sciences, med tech, some in energy transition, consumer electronics. And just having spent a week in mainland China, I was amazed just at how a new generation of entrepreneurs are carrying forward. So I think it's very hard to not, if you're a growth investor or someone who's focused on innovation, it's hard not to put China at the top of the list in terms of opportunity set. I think India is also having its digital decade. If you look at some of the facts over the last 5 to 10 years in India, I mean, you have Jio, the mobile internet provider, over 500 million users. Their Alipay equivalent, a company called PhonePe, has 600 million daily users, and the payment system has been largely automated in India. So I think India is having a really significant moment in terms of its innovation and entrepreneurship that's happening. So I think those have to be at the top of the list. And I think despite the fact that the pendulum swings in terms of the attractiveness of sustainability, energy transition, climate change, I think the reality is we're in for an energy transition that's going to take place over 25 years, and we're going to need a lot of capital to be invested to facilitate the energy transition, and we're going to need a lot of new technologies. And that's been our focus, is what are the technologies that will facilitate energy transition, sustainability, as the demand for power around the world is, if anything, it's inflecting up significantly because of AI. So I think the opportunities for that theme, you know, the energy transition theme, are alive and well, and will be for a while.
Yeah. Thanks. Just a quick remark. It's okay to talk about green in Hong Kong. You can still use that word. Okay. Let me turn to comp. Switzerland. I really want to talk to you about Switzerland. Switzerland has always benefited from periods of uncertainty. Because Switzerland, because of its neutrality, because of its financial stability all along, it always benefits from these kind of uncertain environment. How do you see Switzerland fitting into the current landscape?
Well, I think Switzerland is not quite as big a country as we realize. It's 9 million people. It's the center of global wealth management, or was rapidly being approached by Hong Kong and Singapore. It has always been a neutral country and has benefited from that. In many ways, it's cost it, because the Swiss franc as an overspill currency, as a reserve, gets very expensive. But Switzerland is facing a crossroads here, because it's facing some major challenges. For the first time, it's facing a threat in global wealth management from centers like Hong Kong and Singapore. Secondly, its pharmaceutical industry is being hollowed out as a result of the tariff talks and so on, and relocation of manufacturing. And thirdly, it's having a bit of an identity crisis about what its role is in world banking. I'll talk about that separately. So I think Switzerland is losing some of that luster as other centers are now competing with it for capital.
Do you see that as a competitive relations, or are there any other way of putting these markets together to collaborate? Like Hong Kong, Singapore, you mentioned, that quickly catching up?
Well, the world is an increasingly linked place from a regulatory point of view, and we have two major disconnects in global regulation. One you've heard me talk about before, which is the lack of regulation or effective regulation in the shadow banking system. I'm not trying to upset anybody in this room like I did a few years ago. And the second one is actually, if you look at the regulated banking industry, you've now seen a different speed in terms of, let's call it simplification, whether it's the US, which is leading the way, quite rightly, I think, because the US has decided that capital is yesterday's problem. And what you need to do is, having settled the issue of capital for banks, you need to have effective regulation to let economies grow. And slowly the UK is following. The ECB doesn't quite know what to do yet, and Switzerland is going the other way. So, you know, so you've got these two big trends in global regulation, one where there's lack of effective regulation, and the other where there's a disparate speed in regulation.
Interesting that you mentioned regulation repeatedly, because one of the areas that we want to talk about is deregulation, because increasingly I've heard that word being mumbled in the international community, particularly amongst the major markets. If I want you to pick one area of regulation that you think can be simplified or deregulated, what would you pick?
Well, I think the US is doing it. They're talking about deregulation. In fact, what it is simplification and focus on what needs to be done. Let's take an example. Everybody says that Silicon Valley Bank was a failure of regulation. It was a failure of regulation because of incomplete application of the rules that were in place. There already were rules, but the regulators did not apply those rules properly. They got too caught up on orthodoxy, on rule application itself. When you have a CCAR submission that's 125,000 pages, who reads it? When you have 450 regulators sitting in a bank every day, what are they doing? I think this is what the current administration in the US is trying to do, is trying to assess what is the risk, what are we trying to do? And in fact now, if you look at what's happening in the UK with respect, and certainly with the SSM in Europe, what we've got is total form over substance. And I think this is something that people are now trying to change.
It's interesting you mentioned CCAR. I trust that means that you think FINMA is doing all the right things. Sorry, you don't have to answer the questions.
Thank you, Arthur.
George, your pick of one area for simplification, deregulation?
So I'll probably pick two, if you allow me, Arthur. The first one is prudential. We've all been told Basel III is the solution of unification of prudential regulation across the planet. Basel III has gone in all sorts of different directions. Actually, even the name, is it Basel III, 3.1, 3.5, Basel IV, Basel III Endgame, and I can go on.
3.
That's the Hong Kong. So, but the substantive problem is still there. We have very different interpretations of Basel III, some of it known, some of it unknown, but definitely more on the divergent track. And that's not helpful. That's not helpful because of financial markets are inherently international, and if you're not playing by the same rules and the same standards, there is going to be risks of concentrations in areas of activities that is going to become unhealthy. The second area I want to call out is regulation of the fully unregulated space of stablecoin issuers. Now, arguably, some of the non-bank financial institutions have lighter regulation than banks, but at least we're playing by the same standards of financial crime, the same standards of regulation, and we can argue about how light or not light. But there are segments of the world of finance that are totally unregulated. They're called DeFi, or they used to be called DeFi, and inherently go against what central banks stand for, which is centralization of finance. So there is a real risk that that this is a totally segregated space where businesses are being done, where consumers are putting money, where the prudential rules are at best a list of suggestions, and where financial crime rules are abhorred because anonymous payment is really the name of the game, and we know what anonymous payment can lead to in terms of financial crime risks. And that is a real risk that we face, that consumers someday may face challenges, and no one here from the regulated industries is supposedly here to support them.
Thank you. Turning back to you, Kom, just very quickly, this topic about deregulation or simplification, it was actually founded on the basis that we're entering an era of slower growth, and therefore policymakers do need to strike the right balance between stability, financial stability, and growth and developments. You think that balance could easily be struck? And is that an impossible sort of dual goals?
Look, I think regulators lost control because in their desire to over-regulate the banking system, they chased a huge amount of product out of the banking system into the shadow banking sector, which is not regulated on the same basis. And if you look at what Besant is doing in the States, it is trying to kickstart the economy. It's trying to feed lubricant into the economy to get banks to lend more because they can control that. But no, I don't think they do have control. For instance, let's take, and I hope I upset nobody in this room now, but let's take the insurance business, right? Increasingly in insurance business, particularly in the States, it's regulated on a state-by-state basis, not a national basis. We're beginning to see huge rating agency arbitrage in the insurance business. Remember in 2007, subprime was all about rating agency arbitrage. What you're seeing now is a massive growth in small rating agencies ticking the box for compliance of investment. And these things actually, whereas a few years ago I got into trouble with my good friend John and Mark for mentioning private credit, let's not talk about that anymore. If we look at that, to me was never systemic, that was fiduciary. But if we look at the insurance business, to me there is a looming systemic risk coming through, and it's because of lack of effective regulation.
Thanks. Finally, we have a little bit of time left. Can we turn to AI? And for that one, I would turn to George and Bill. The AI-related investments. First of all, to George. This is really a mega trend right now. I checked the data in the past 2 months alone. Something like 20 billion of financing have been poured into constructing data centers across US and Europe for AI purposes. What do you take of this trend?
So Arthur, this is a tricky question because first the numbers actually are staggeringly higher. Well, at least the commitments are staggeringly higher. We're talking multiple hundreds of billions of dollars, if not into the $1 trillion of investment data centers. It's tricky because on the one hand, we need the compute. And for all users, be it personal or corporate, we can see that the compute becomes sometimes a challenge and the availability and the speed of reaction is not there. But on the other hand, the revenue profiles can't necessarily match the, can't necessarily justify the spend. Consumers aren't ready to pay for it or very low, and businesses are ready to pay for it, but they're going to be cautious because the benefits cases will not materialize in productivity in a year or two. These are like 5-year trends, and therefore, the ramp up means that we will start seeing real revenue benefits and real readiness to pay for it probably later than, than the expectations of, of investments are.
Yeah. Then turn to the investor perspective, Bill.
Yeah, it's been, first of all, I think it's hard to overstate the impact that AI is going to have over the long term on the overall global economy, the tech sector, et cetera. And I think that's why you've seen somewhere between $750 billion and $1 trillion invested already. I mean, the estimates are another $500 billion next year. And I think this is because people recognize the long-term impact that's going to have. But like so many new technologies, there is going to be misallocation of capital destruction, overvaluation, irrational exuberance. But I do think long-term you're going to create a whole new set of industries and applications, and there will be a productivity payoff. But that's a 10, 20-year play. But the problem is you need to make the investments now. Unlike the internet, this cycle is very capital intensive, and you need to sort of pay up front for the opportunity that's going to come down the road.
And as George mentioned, the return profile is very different from the internet age.
It's hard to pick winners and losers right now, and it's hard to know the exact nature of the return. You're really betting on this being a broad-based technology, more like railroads or electricity, that had profound impacts over time, but and reshaped the economy. But we're very hard to predict exactly how in the first few years.
Yeah. Okay, thank you very much. We have used up all the times allocated to us. Let's put our hands together for the generous sharing by the panelists. Thank you very much.
Thank you very much, Arthur, and our speakers. May I now invite you to take a photo at the front of the stage, please. Please remain on stage for a group photo. Please look to our official camera in the front. And now to the back, left black. Thank you very much, our speakers. You may now be seated. We've just explored the macro changes shaping our world. But what do they mean for the markets? In this next session, our panelists will share with us some of the most exciting opportunities on the horizon, the critical risks to watch out for, and the key trends set to define the time ahead. Please give a warm welcome to our moderator, Julia Leung, from the Securities and Futures Commission, and our panelists, Mike Gitlin from Capital Group, Ted Pick from Morgan Stanley, and David Solomon from Goldman Sachs. Julia, over to you. Thank you.
A very warm welcome to our panel on markets. And I'm glad that I'm joined by three CEOs who need no introduction. I'm Mike, Ted, and David. Just now, Arthur's panel on macro economics trends set a perfect backdrop to what we are discussing. To borrow the summit's theme of tracking and shifting terrains, the terrains have indeed shifted quite a bit in the last year since we last met here. Our macro panel speakers have just spoke of trade tensions, refiguration of supply chain, the AI and the technology, the money that's been plowed into technology, and of course the regulatory landscape, which are moving in different speeds and moving in different directions. Against this backdrop, tracking is undoubtedly difficult, given the low visibility of what comes next. But when it comes to market, which is the theme of this panel, it's almost paradoxical that these uncertainties have not dampened the party spirit. US equities are setting record highs, Driven by AI, deregulation, and rate cuts, so are many of Asia's equities market. Japan's Nikkei and Korea's KOSPI has hit new highs. Shanghai Composite is in the highest in a decade, helped by easing US-China sanctions and softening of US dollar and growing diversification. Hedges and alternatives are also booming. Gold, silver, Bitcoin prices have been up sharply, so are private markets and structured products. So is it risk on or risk off, or it's just formal? Surely alarm bells have set off. Jay Powers of US Fed sounded caution on the US stocks valuation. Andrew Bailey of Bank of England was concerned about the rapid growth of structured products, and IMF warned of the potential for a sharp market correction. To borrow an English idiom, which is often used in Chinese in exactly the same term, some would say the risk-reward profile right now is like pulling chestnuts out of the fire. So would the proverbial cat's paws be burned? So that's why, gentlemen, here's my first question for your quick take. Is all this sustainable going into 2026? I'll start with Mike.
Well, thank you, and I appreciate being here. Is it all sustainable going into 26? We tend to think of 2036 more than 2026, but if you look forward, what are some of the things that are sustainable? AI deployment and diffusion, adoption, productivity will continue to get better. It will take a long time, but it will continue to get better. Diversification into non-dollar assets. We continue to see demand for non-dollar assets around the world. Dispersion in terms of corporate opportunities and company opportunities around the world for investment. We talked a little bit about deregulation. There's a positive growth impulse to that, and I think the economies, and Colm talked about this, and I always love presenting after Colm. It makes it so much easier, so thank you. If you look at the deregulation, I think that's a positive growth impulse. And last, earnings. Earnings are strong, and that's super important. What's a little more challenging are valuations. I think everybody in this room, if we looked at a pendulum or a scale and said we had cheap, fair, and full value, and you had a plot somewhere on there, I think the majority of people in the room would say we're somewhere between fair and full. But I don't think a lot of people would say we're between cheap and fair. So on a valuation perspective, that's challenging. And I think if you look at the credit markets as well, if you look at 30 years of data, we're in the richest decile of credit spreads. So stock markets aren't cheap, credit's not cheap, and there's speculation in both precious metals and also cryptocurrency. So I think on a near-term valuation side, there's some challenges, but there's some long-term sustainability in some of the themes.
Ted.
Yeah, I agree with everything Gitch just said. We've come a long way. There's still policy error risk. There's still geopolitical uncertainty. But you know, you think about where we were a year ago sitting on this stage, new administration coming in, talking about re-architecting industrial policy and addressing these enormous fiscal and trade imbalances. And look at what's happened. In April, we had the height of the headwinds when we had DOGE and immigration and the bill being put through and tariffs if the courts hold them up. So we come to today, and yes, markets seem expensive, as Mike said, but the reality is systematic risk is probably narrowed. So if we were sitting here thinking last year about whether risk-taking in equities was itself problematic, now we're talking about valuation itself, which gets me to the same place looking into 2026, which is earnings. I think to the extent that companies are able to demonstrate on the back of pretty benign consumer and corporate data that they can inure the needed spend on AI and they can actually continue to build comparative advantage and produce good earnings, they're going to outperform. We're going to see that dispersion. Those companies that can't, they will underperform. But the new issue market is active around the world. Investors want to take risks, so I'd say the overall environment feels pretty good going forward. We should also welcome the possibility that there would be drawdowns, 10 to 15% drawdowns that are not driven by some sort of macro cliff effect, just the reality that, for example, metals have really run. I think that's a healthy development, and what we'll be looking to see in 26 is whether the market, in fact, broadens and we see that kind of dispersion.
So David, would you agree with them or not?
Well, going third is always easier because the two smart gentlemen on the stage have said most of what I would say on those topics. I mean, things I'd add just for perspective. You know, in 1996, Alan Greenspan started talking about irrational exuberance in markets, and the NASDAQ was 1,300, and it peaked 3.5 years later at over 5,000. So when you have these cycles, things can run for a period of time. But there are things that will change sentiment and will create drawdowns or change the perspective on the growth trajectory, and none of us are smart enough to see them until they actually occur. And it won't be any different, you know, this time at some point. You know, technology multiples are full. I'd say technology multiples are kind of 80th percentile in a historical context. But when you look at the broad market, there are lots of things where the multiples aren't as full, especially given earnings growth and kind of the momentum in economies. Most governments are running most developed economies are running very, very aggressive fiscal plays, and that, you know, underlies economic strength and forward momentum. And so I think it's a pretty constructive environment. Give you lots of things that could go wrong, but at the moment, those don't seem likely in the short-term distribution of outcomes.
Well, David, you actually, my next set of questions is about strategic asset allocation, which will be directed individually to you. So I'll start with David. You actually mentioned drawdown and Ted as well. Not recently, then you have actually say that you expect and predict a drawdown in the next 12 to 24 months. That's a very long span. What are the factors? I mean, maybe you can elaborate on the factors that trigger that drawdown. And you guys have avoided using correction or crash or something, but drawdown. So explain what is your advice giving your clients to prepare for that drawdown?
Our advice generally, the firm's advice for a long period of time has been to stay invested and look at your portfolio allocation, stay invested, and that advice has served people well. You know, none of us are market timers. It's a little bit what Mike said. He's looking at 2036, not 2026. But if you believe in growth in the world, you have a portfolio allocation as a global capital allocator, and generally speaking, you know, a 10 to 15% drawdown, which by the way happens often through, you know, even positive market cycles, is not something that changes your fundamental, you know, structural belief as to how you want to allocate capital. So, you know, when I made that comment at Italian Tech Week about a month ago. I said, and I don't remember how the question was framed, but the question was framed in a way where I said, of course, it is likely there'll be, you know, a 10 to 20% drawdown in equity markets sometime in the next 12 to 24 months. And I'd say there are very few people in this room that don't think that that's a meaningful possibility. It doesn't mean that the general direction of capital flows, investment, portfolio allocations changing. It just means things run and then they pull back so people can reassess.
All right, it's more like while the music goes on, then let's continue to dance.
No, I didn't say that.
Right. Ted, as a strategy to diversify, investors have increased allocation to alternative investments. Like Morgan Stanley has suggested between 15 to 20% allocation to alternatives. So which alternative assets in particular, and private market seems to present a case of high risk, high reward, as seen in the First Brands bankruptcy. So how are you going to take advantage of these opportunities while mitigating the risk, or, so to say, avoid the cockroaches that your peers said?
Well, diversification, risk management, they all matter. Pricing, liquidity. The context here is that the private assets market has tripled to 15 trillion over the last decade. So there's been the real institutional branding of the product, and now it's come of age. Over the last 12 to 18 months, we've now begun to see, through deregulation and technology innovation, the democratization of those private assets for retail. And that is exciting, because the retail investor wants to have the opportunity to own a SpaceX, for example, in the years before it goes public. Private companies stay private for 14 years instead of 5. So some of that alpha is interesting to get to to high net worth. If you look at our own allocation to private assets, we have about $5 trillion of non-self-directed wealth management assets in the U.S., and about $250 of that $5 trillion is in private assets across private equity, private credit, real estate infrastructure. That's about a 5% weighting, right? 250 over 5 trillion. And I would think over time, over the long span of time, that number could work its way towards 10%, but diversification will be important. And for us, we're open architecture. The $250 billion that we have is over 260 managers. We have product from these gentlemen's shops. We also have evergreen products where you can, on single ticket, a product we call PMAX, you can have a single ticket that gives you diversified coverage and investment to a broad array of strategies, so you are protected from the single CUSIP or single company experience. The other piece of this, of course, is the ability to trade those private assets, and there too, I think that's going to be an exciting development. There are products and companies like EquityZen that will be able to trade these private assets on a single name basis before they go public. That's interesting for those private companies as they look to grow into fees option plans, but it's also interesting for investors who want to be able to allocate not just funds across these strategies, but single companies too.
So diversification is still, diversifying from the public market is still part of the theme going forward.
Yeah, I think the theme is important, and importantly, when you think about some of the developments that folks on this stage are looking at where they can have strategies that incorporate some of the best of public and private investing in a single product, that could be interesting. But diversifying amongst the private asset class and best of breed and having hygiene around diligence, really knowing where those asset managers have excellence is important, and then obviously layering into that over the long span of time. And then importantly, too, to be considering what your real liquidity preference is at the client level. And that's an education for the financial advisor, knowing their clients and what kind of liquidity windows they actually have, both for investing and then also for wealth transfer, tax optimization, all of that. The technology that is coming to age is pretty exciting around the ability to actually do that in an effective way at the individual investor level.
I certainly agree. We in Hong Kong are looking at hybrids where on the retailization of private funds, then we are more like hybrids as a starting point for education. Let me turn to Mike, fixed income. So in this highly uncertain political environment and with fiscal debt, which our previous panel talked about being in a very high level for development markets, some would say that they would avoid US Treasury. The fiscal debt situation has worsened, but none of you actually highlight it as an area for concern. But because everyone is talking about 2035, you started it. So, but I think corporate credits still, even though they're still fairly tight. So what kind of investor portfolio mix would you look at? Will there be a change in maturities that one should look into going into the near term, not 35, please?
Yeah. Well, if you look at fixed income, one of the things you do when spreads are tight is you go up in credit quality. So we're seeing a lot of interest in high yield from going from triple C's up to single B's and double B's, with investment grade going from triple B's up to single A and double A. Just go up in credit quality. The diversification benefits of fixed income are real. 2022 was an anomaly. It's very rare you have zero interest rate periods where rates go up 500 basis points very quickly. So those diversification benefits are real. If you look over the last 30 years in the public markets in a 60-40 portfolio, and the 60-40 portfolio's death is greatly exaggerated. If you look at the returns over that 30-year period, you've annualized 9% returns. Super good. Public market, transparent, liquid, relatively inexpensive, so benefits from those diversification. And then I think if you look at the macro environment, monetary policy is supportive. So if we look back 3 years and you're looking at returns in the fixed income market, corporate, core, high yield, emerging market debt, your annualized returns in these asset classes over the last 3 years is anywhere between 5 and 11%. So if you have 7% capital market assumptions, you're getting a long way there in your fixed income total returns, and your starting point in yields today is a pretty good indicator of your 5-year forward-looking return. So if the risk-free rate is still relatively high, fixed income still constructive. It doesn't mean spreads aren't tight. It just means all-in yields are relatively high, and if company earnings, like Ted mentioned, remain strong, it's still a constructive environment.
Thank you. My next set of questions is about continuing on the theme of asset diversification, but we'll focus on geographical regions, and particularly China and rest of Asia. I'll start with David again. Goldman Sachs has been very active in China, and I just learned that you're flying up to Beijing after this, this morning's session. So since this DeepSeek moment, people are taking a different view on China, and given what's happened last week with the, what do you call, truce or trade pact between US and China, how are sentiments changing, and what would you like, and what would you see in the next few years?
I'll make a couple of comments around that. I mean, you know, sentiment with respect to Chinese equities certainly had a lot of room to change if you go back to a year ago. You know, after what happened in 2020 and 2021 and 2022, kind of six trillion was wiped out. And so you've seen year over year since we were last year about an 80% move in Chinese equities, and that kind of makes up about half of what was lost during that, you know, during that period. And I think it's reflective of whether it's the DeepSeek moment or just a more normalized kind of long-term view, and also just the fact that on a global basis with valuations moving up, you know, a lot of these Chinese equities look very, very attractive. China is one of the largest, most important economies in the world. Global capital allocators will continue to be interested in China in almost any environment. You know, I think what you've seen over the course of the last year is a little bit, after a shift away, a little bit of a shift back from global capital allocators. And, you know, my guess is that'll continue with this a little bit greater stability over the course of the next year versus what we've seen over the last 12 months.
I move to Ted for the rest of Asia. You've seen actually the regional markets are actually growing very rapidly as well. That includes India, Japan, and Southeast Asia. So the MSCI Asia Pacific Index are up 20% this year. So we remain positive. Morgan Stanley remain positive on Asia in this region. So which are the markets which really excites you, and which are the markets which are more developed markets or more EM markets?
Well, I would echo David's comments. Hong Kong, China is where it begins and ends. The developments, if you believe in a market where investors will reward great companies and where dispersion matters, AI, robotics, EV, biotech, you have not just national champions, but global winners that are listing in Hong Kong, raising capital, and effectively establishing themselves as world's top 2, 3, 4, 500 companies immediately. So really, you start here. But as you look to in Japan, and you start thinking about not just diversification across asset classes, but diversification across geographies, it's hard not to be excited about Hong Kong, China, Japan, and India, 3 vastly different narratives, but all part of a global Asia story. In Japan, you see the reawakening of investor interest and corporate governance, and there is a ton of corporate activity that is underway and will continue. And then you have in Japan the reality of demography and the very slow but inexorable move of yen plus real estate is a savings portfolio into something that looks like a traditional invested portfolio, and that's something we're very excited about. And then India has enormous infrastructure-led runway, will be one of the world's most deeply held markets once we see the kind of deregulation that we would expect over the next 5, 10, 15 years. So if you think about the next 5 years, and we talk about the need to diversify as between risk and non-risk assets and between public and private assets, it really does matter now to have that geographic footprint in all 3 major locations. Very different narratives, but all should generate alpha and positive risk-adjusted returns over the next 3, 5, 10, 20 years.
So Mike, a year ago, or even before then, we're talking about the growing power of passives, and passives ETFs been like dominating. New money is going into passives. But now it seems that it's moving to active and active ETFs again. Maybe you explain a little bit about that trend change and where would it lead to, and how should Asian investors benefit from it?
Yeah, I think what's starting in the US is expanding globally. If you look at ETFs, it's an investment vehicle. For 30 years, we let the vehicle be described as passive because there weren't active alternatives. Now that there are active alternatives, the adoption rate is much faster than any of us would have imagined. I'll just give you a sense for us. We launched active ETFs in the US 3 years ago. We reached $100 billion of assets this week. And the flow rate is about $1 billion per week. So the interest in getting those active outperformance in the ETF vehicle that's so well desired, again, in the US for mainly tax reasons as well, but globally the vehicle adoption's growing. I think what you'll see over time is that installed base, so back to the US ETF market, 90% still passive, 10% active. The flow rate is about 35 to 40% into active. So over time, 90-10 will be 80-20, 70-30, et cetera, just for the opportunity to be able to gain the intellectual capital in a different vehicle other than a mutual fund or a separately managed account or a collective investment trust. It's just a vehicle of choice mentality, and the adoption rate tends to be high when you offer the vehicle that consumers want.
We have enough time for one more question for all three, a quick response. We've been talking about the trillions or hundreds of billions of US dollars plowed into AI, but we're not seeing, and the return will be spread out maybe 10 years, 2035. So, but in between, the investors might be, as the next 2 years, not 10 years. And also, where is the biggest crack? That is Mike first, and then go all the way.
When you look at AI in general, I think of it on a continuum, and Gen AI in terms of augmentation and making people more efficient. You go out to agentic AI, robotic AI, quantum computing. The world is pricing AI as if it's further along that continuum than it really is in terms of actual effectiveness today. So I don't think there's a huge debate in that. Everyone uses the term overestimating the impact in the near term, underestimating the long term. While I believe that, the valuations today would suggest there's a lot built in to future expectations.
Ted?
Yeah, I agree with that. There'll be some capital misallocation, but it's here, and it will transform itself from something that is an efficiency tool to something that is intrinsically an effectiveness tool, and it's something where the genie's not going to be put back in the bottle. And as such, will actually, at the risk of crowding out investment in the short term, be something that could power global growth for a long time.
David, you have the last word.
I agree with what my colleague said. It's a journey. You know, there's a lot of focus right now on data centers and chips and compute, and some very smart people I talk to are focused on a lot of value being created in applications and the application layer. But whenever there's excitement about a new technology, and this is real, you know, people believe the opportunity, and generally speaking, things run ahead of the speed at which it ramps up. My guess is we'll see some of that here. But in the long run, these are really, you know, interesting opportunities, and a lot of capital will be winners and losers, just as there always has been. And, you know, we'll experience that in the coming years.
Thank you. That remains for me to thank our speakers and in this very agreeable panel, and for all of you to put your hands together to have had more.
Thank you, Julia, and our panelists. Please remain on stage for a quick photo. Please now look towards the left for our media friends. Okay. Thank you. Thank you to our speakers. Ladies and gentlemen, we'll now take a 15-minute break. Coffee and refreshments will be served in the foyer area, and we'll see you shortly. Thank you. Ladies and gentlemen, the next session is about to begin. Kindly return to your seats as quickly as possible. Ladies and gentlemen, the next session is about to begin. Kindly return to your seats as quickly as possible. Ladies and gentlemen, the next session is about to begin. Kindly return to your seats as quickly as possible. Thank you. Hello everyone, welcome back. Up next, we're thrilled to have with us industry leaders coming from the two ends of the market spectrum. Their firms have been dominating forces in the public and private markets respectively, and are both looking to expand into the other markets. They share their perspectives with us on this hybrid investment approach and other markets dynamics in this next panel. Let us now welcome our moderator, Daryl Chen from the Hong Kong Monetary Authority, and joining him on stage, we're honored to have Jonathan Gray from Blackstone and Emmanuel Roman from PIMCO. Daryl, over to you. Thank you.
Okay, welcome back. And good morning to everyone. Welcome, John. Welcome, Manny, for joining us today. And now, this panel is about best of both worlds. And so we'll be covering both public and private markets. But let's start with something less clear-cut, which is the convergence or the blurring of the two markets. John, since you took up the current role, you doubled the AUM of Blackstone, and now you're the biggest alternative asset manager. And for many, since you took over the PIMCO role, you turned around the fixed income business, and you're now truly a bond giant. So my first question to both of you is that, okay, you seem to be doing remarkably well in your respective space, but why are you interested in the other's playground?
Oh, I love that question, Daryl. It's great to be here. Congrats to Eddie and everybody at HKMA for another great conference. I guess I'd say it a little bit differently, which is what we've really been on is a journey to expand access to private markets. that if you went back a couple decades ago, we had just a couple hundred customers, pension plans, sovereign wealth plans, funds, endowments. And what we've been trying to do is say, how can we expand the benefits of the higher returns from alternatives, the diversification benefits? What can we do? And so we've expanded with insurance clients, more institutional clients, and then in the wealth arena, the idea has been, can we create products that others can access? And so we started 20 years ago with individual investors in drawdown funds, about a decade ago in these semi-liquid funds, and now we're moving towards products that partner with best-in-class liquid managers. We've got a growing partnership with both Vanguard and Wellington in active and passive liquid, both debt and equity. And the idea is, if we partner those with our products, can you offer something really compelling to individual investors? I think it's a similar story in the 401k arena, where we're likely to partner with leading liquid providers as well. So it's not really about expanding our footprint so much into the liquid arena as it is expanding privates and what we do in order to give those differentiated returns to individual investors.
Well, thank you. That's a great story. I think the 401k was certainly something very exciting, looking forward to. So, Manny, you want to fight back, right?
Well, thank you for having me. No, I'm not going to. Let me take another stake at this. Let's say you build a portfolio right now, investment grade, you get to something like 7% yield. Yeah. And the yield is a good forward predictor of future returns. So keep in mind the 7%. Now I want to increase the yield. There are 3 ways to doing it. Leverage, going down in credit quality, and becoming more liquid. There's no miracle. That's the way you get to higher return. And it may or may not be attractive depending on relative value. So John needs to borrow money for his private equity business. I don't do private equity, but he's a fiduciary, right? So he's going to try to borrow money. He's going to call his 10 closest friends, I'm one of them, and he's going to try to get the best deal for his leverage buyout. And there's a classic problem of Wunder's curse. And so if I can get 7.5 in direct lending in a weak single B credit, he's doing his job. I may not doing mine because I don't think it's that attractive. Right. But if I can get 10, then I think it's very attractive. And so it's all in the price. And I think you have an equilibrium where everyone is trying to do the right thing, but market prices dictate behavior, and one shouldn't take illiquidity for the sake of taking illiquidity.
So I think that's the point that it's really about return, but for John's case, it's really about the access by the smaller investors. So maybe before long, we're going to see tokenization of private equity in some case. Anyway, but it seems that these are 2 very different markets. So in terms of investment strategy, your philosophy, your risk management, and also, do you also see the kind of synergy or complementarity getting into 2 different markets?
Well, I definitely think there's a complementary nature of bringing liquid assets next to private assets. If you think about the liquid market is so important for investors, but the S&P 500 today is 10 stocks or 40% of the overall market cap. And we know there's obviously a lot of volatility, sentiment moves things. We saw that certainly during COVID or after Liberation Day, liquid markets move very, very quickly. So the idea of having some ballast for investors, institutional, insurance companies, individuals, makes a lot of sense. You know, what it gives you is exposure to real estate at much greater scale than you can get in public markets, things like infrastructure. Something like almost 90% of the private companies in the US that have more than $100 million in revenue are private. And so to be able to construct a portfolio that gives you access to all of those companies and puts it side by side with your liquids portfolio makes sense. So no one's up here saying you're going to put 100% of your assets in private markets. But should you put 10, 20, 30%, most of the big institutional clients we have put about 1/3 in, because, again, the premium returns and the diversification benefits. So to us, this is just sort of a natural journey. It continues to expand, but again, you have to deliver for the clients because they are trading away a measure of liquidity.
So let me take a slightly different angle. In fixed income, you have a biodiversity second to none. So you have a very liquid market, you have structured product, you have asset-backed finance, you have a municipal bond market, you have more exotic type of payout like royalty finance and aviation and so on and so forth. And so at any point in time, different segment of the market may be more or less attractive depending on what the opportunity is. So I think either Ted or David mentioned before that investment grades are very, very tight. They're tight. It's good for John to borrow. It's less good for me to invest. And high yields are very expensive. You know, we have this chart which shows that between 1992 and 2008, you made 70 bips a year owning high yield. You lost everything in 2008 and more. And so we haven't seen a recession. And so to some extent, some of these returns in higher octane type of fixed income haven't been really tested. And I'm not being provocative. I'm making a very obvious point that in a growing economy, when things are good and there's no recession, things look better than they ought to on a risk-adjusted basis.
Yeah, that makes a lot of sense, I mean, in terms of allocation. So let's move on to the next question, which is about private markets. Now, John, the first question is, some say that the private credit space has been having a lot of strong traction in recent years, and that partly has to do with the challenges in fundraising as well as exit in the PE space. What's your take on that?
I see it a little differently, Daryl. I think it really has happened because of the excess return you've been able to deliver. If you think about what private credit is, we're bringing an investor, let's say an institution, right up to the borrower, and in the process, eliminating a lot of origination, securitization, all those costs that ultimately take away from the individual, from the ultimate end investor. And so when you're able to have that direct-to-customer model, farm to table, you can deliver higher returns. For our insurance clients with private investment grade, we've been delivering in the last year 170 basis points premium. So if you can deliver 7% instead of 5%, that's very helpful. Similar story in the leveraged loan market versus direct lending, where again, by having that direct-to-customer model, you provide a premium. So that to me has really been the driving force. It was certainly accelerated after the inflation surge, after rates went up and spreads widened because you got these very, very high rates of return. But that cyclical element, as it goes away, doesn't take away from the long-term secular benefits of private credit. And so I think this trend will continue, and it will take up a larger component of investors' portfolios. Again, they'll still have a very large liquid fixed income portfolio, but just like they have a big public equity portfolio, they now have a larger private equity portfolio. It'll be the same dynamic in credit.
Okay, thank you. That's the upside, but let me talk a bit about risk in the private credit space. Now, in a media interview in August, you said, and I quote, "Private markets haven't been tested." And recently, we're seeing some high-profile bankruptcy cases in some private credit-backed investments. There's even mention of the crawling little creatures out there.
Not my words.
So, what's
no, look,
take?
I think here's the way to understand it. You have a mortgage market which is super efficient. For lower quality borrower, you always had other form of financing where the credit is much worse, and then the risk of fraud is higher. I mean, I was telling you when we were preparing for this that I remember a case in 1999 which pretty much looked like the one we're seeing today. Right. And so if you've been through this and you've seen fake invoicing and all of these things that we both know about, I think you sort of mentally prepare for it and you make sure that you don't do it. And so that's, I think, part number one. How many more are there? I think it's very hard to tell. I think everyone in this room scrub their book and try to make sure that none of us are exposed to this. But it could be that one of the sector where you've seen a lot of activity, like software, for example, where AI is going to be a major disruptor, you're going to have a problem, not because anyone is doing anything wrong, simply because there's a business model that is being destroyed by technology. And I think that's, that's a Schumpeterian way of looking at an ecosystem, and I think that's, I think that keeps everyone in this room awake at night, because, it's a good, bad thing in terms of what's happening.
John, you want to jump in on that point?
Well, I would agree with Manny's comment. I think these high-profile bankruptcies were interesting in that they were non-institutional borrowers. What we tend to do is lend to private equity firms or public companies. These were non-traditional borrowers. They also, it appears, committed fraud, asset-backed, where there wasn't really assets there. And then to look at that and say somehow, therefore, the direct lending market or the investment-grade private credit market is flawed, particularly where in both of the high-profile cases, these were bank-led situations, that seems like an odd conclusion. But it matters how people underwrite. And yes, you have to be mindful of what you're doing in the credit space. But I think these are both idiosyncratic. And when we look at the overall credit books of the banks, of public debt markets, of the private credit, you see very low default rates, very low losses. To me, that's more representative than a couple of these idiosyncratic cases.
Okay, thank you. So perhaps no need to grab the pesticides, at least for now. Right?
Agree.
Oh, okay. So my next question is on AI. So everyone is talking about AI. We can't avoid that. Private credit and PE, big investors in AI infrastructure, data centers in particular. But there's also increasing concern whether there's actually a bubble out there. And so there's a guy saying that, well, okay, so this time it's probably a good bubble, well, meaning that, well, the investment put into it, the productivity gain, that will actually benefit, leaving lasting benefit for the society, even if the shares collapsed. So do we have a bubble, good bubble or bad bubble? John?
I'm a little more optimistic. Whenever you have this kind of change, doesn't matter, railroads, electricity, the internet, there will be misallocations of capital, there will be bad business models, there will be people who lose, no question. And there'll be an excess of enthusiasm in certain areas. But the power of this technology is really remarkable. The idea of super intelligence at scale at almost no cost other than electricity, that is really powerful. And when you start to think about the use cases in coding and customer service and content creation, the list goes on. And we're at the very beginning of these use cases. If you think aggregately, there's $60 trillion of labor spend. If this technology makes individuals, companies, 15% more productive, that's $9 trillion a year. That can cover a lot of spend for data centers and for gas plants and all the infrastructure that needs to make this compute power a reality. So I'm definitely aggregately more optimistic that what's happening makes sense because the size of the prize is so large, but acknowledging there'll be losses. The other thing, and I think Manny was very smart to point this out, is that everyone's focused on this bubble over here. I think what you have to be concerned about as an investor is the disruption that's coming. It could be lower value-added IT services. It could be certain horizontal enterprise software companies. It could be what happens in the auto supply chain or auto insurance as a result of autonomous vehicles. I think underestimating what will happen, even if these changes take time and as multiples compress, as people get worried, that's the thing as investors we've got to worry about. There seems to be these days much more focus on the bubble and misallocation of capital. I think we also want to look behind us at the pace of disruption and what it could mean for our portfolios.
But you also mentioned that Blackstone is actually placing AI on the top of your risk list. What do you mean by that?
Well, we're just looking at every deal that comes through the door, and we're saying in the first 2 pages of the memo, tell us about the risk of disruption. We're also looking at our existing portfolio and sort of saying yellow, red, green, you know, how much risk do we have? Is there a way to exit this company faster or this credit faster? And then I would say, in order to reduce our risk, we're also really focused on the picks and shovels. So really focused on being the biggest investor in the data center space with long-term leases, really focused on the electricity that's needed for the data centers, for the robotics, for the autonomous vehicles. So I think as investors, you want to try to find ways to play this derivatively and reduce your risk, because there will be some losses.
Thank you. Manny, you just did a great deal. So can you tell us a bit more about that? And then your thesis of investing in AI and apart from data.
Well, I think the beauty of it, you know, in terms of, I mean, and you know, I'm a little biased because we just did a deal with our friend from Morgan Stanley, a $29 billion giant, lending to one of these companies. So, you know, I may have to eat my own cooking. But the company who issued these giant bonds all have AA or AAA rating. I mean, it's incredibly safe. And because the market valuation is so high, if you plug the amount of debt being borrowed in a Merton model in terms of debt to equity, you'll find that it's pretty riskless and very attractive. And, you know, whether they decide to go to the public market like Oracle or whether they decide to go private, we don't know. And, you know, once again, they have very good and very smart CFO who are going to optimize their borrowing ability, and that may be or may not be good for, you know, both of us, and that's totally fine. The one word of caution is that we don't know what inference is going to be in terms of AI, and there's a lot of possible outcome, and I think none of us really know. And I think I would sort of caution with what may or may not happen, because the degree of certainty you have 5 years from now, it's just very hard to know where we're going to be. So maybe we're not building enough data center, maybe we're building a bit too much, who knows? And maybe the data center, some of it will be obsolete, or maybe they won't be. And I think there's a degree of uncertainty in every single big innovation cycle, and that's one of them. And I think we'll recognize this, and we'll try to ride the wave as well as we can. But sometimes you ride the wave and you fall in the wave, and so that's the.
Before it's too late.
That's right.
But I think that word of caution is very helpful. We don't have much time left, so maybe just one last question, moving closer to home. So we just discussed just now while we're waiting. So the public markets here in Hong Kong and in the mainland has been doing, well, the sentiment has come back quite well. So John, how about the private market?
Well, the private market lags a bit on this because as a private investor, your time horizon's longer. So when there's geopolitical uncertainty, when there's a lack of liquidity in markets, private market participants, you know, tend to fall back a bit. What's encouraging is the outcome of the discussions last week, where the economic tensions are starting to come down. We've definitely been believers of letting the tariff diplomacy play out, that it ultimately would settle, that it's in both parties' interests to get to a better place. The second thing is just the revival of the public markets, the fact that the Shanghai index is up big, the Hong Kong index, the IPO market here is now going to be the leading IPO market in the world this year. That signals to investors liquidity is coming back. So I think you'll begin to see more focus on private markets in Greater China. I think there'll be a lot of focus on the domestic market, on growth in consumption, on leisure, hotels, logistics. Those things make sense to me. And I think Hong Kong will probably be the tip of the spear here in terms of the recovery. You can feel people coming into this market. The sentiment is changing. And so this place has had a tough few years, but it feels there'll be some compelling opportunities, particularly in the real estate, which I know has been badly beaten up.
Well, of course, you are a big real estate guy, so, well, that's a good news. Manny, on the credit bond side.
Very, very simple. I think every single investor we have is underinvested in Asia for very obvious reason. If you look at benchmark, Asia is a much bigger part of the benchmark than what they invested in, and so there's a flow of money. Some of it goes through global bonds, some of it goes through global equity, some of it goes to local equity. Hong Kong is the gateway to China and to Asia. It's the center. It's where every one of us has big offices, and it's the role you play, and I think it's very good in terms of capital markets, but it's going to grow. And remember that one of the flip side of what we've seen in the US is there are some countries like Canada and Australia who have more difficult relationship with the US, where their own capital market is not big enough to be able to allocate locally. And so all of a sudden, there is some rebalancing from the US to other parts of the world, and you've seen the dollar correct by 10%. I don't think it's over, but I think you've seen some smallish realignment in terms of flow of funds, and I think you'll see some of this happening here in a positive way.
That's actually very good advice for us while we and the SFC are rolling out a roadmap to really grow our bond market here. Thank you so much for the advice. Now, we're out of time. Again, thank you so much, gentlemen, for your good advice. I just hope that you'll continue to capture the best of both worlds. Ladies and gentlemen, big round of applause. Thank you.
Thank you, Daryl, and our speakers. Please remain on stage for a group photo. Please look towards the back for our media friends. Thank you again to our panelists. You may now return to your seats. Thank you. The private equity landscape is navigating a period of change, with shifting investment strategies and an evolving market environment that are reshaping the competitive landscape. Let's hear from the industry leaders on their take of the stake of the private equity. Please give a warm welcome to our moderator, Juan Delgado Moreira from Hamilton Lane, and our panelists, Joe Bay from KKR, Rob Lucas from CVC, and Harvey Schwartz from Carlyle. Juan, over to you. Thank you.
Thank you. Good morning, everyone. I think the job is, I'm standing in for an extension of HKMA. My job is to ask tough questions as an investor would look at this, and notice the challenge word on the title, right? Fortunately, thanks to the previous panel, we don't have to cover private credit. So that one's done. But I think it's fair to acknowledge that we have a period of transformation and change in the industry. All of us are meeting clients all the time. The first thing that comes top of mind is for the last 25 years, out of those 22 years, you outperform public equities. Congratulations. Unfortunately, the last 2 or 3, you have not. And so it's easy to get used to 22 years of one trend. What does that mean for the future? But I also want to connect that to a number of new developments in the industry, such as the development of secondaries, continuation vehicles, the explosion of a number of new transactions that are taking more and more space into portfolios and becoming front of mind. So with that as a backdrop, I'd like to go to Harvey first, since he's far out in the corner, and just can I have your perspective to kick us off on this evolution and this journey and your outlook for 2026?
Sure. Well, it's great to be back in Hong Kong. Congratulations to Eddie and the HKMA. What a fantastic event for all of us. A little bit of this has been talked about during the course of the morning. I think it was Ted that talked about the fact that companies are staying private for longer, up to 14 years. If you actually go back to you take a look at the Wilshire 5000, the Wilshire 5000 peaked in the late 90s at 7,500 companies. Today, it's just over 3,000 companies. And there's this massive transformation of public companies, not just delaying becoming, private companies, not just delaying becoming public, but also not becoming public at all. And what's occurred during that period, one, as we all know, is the transformative nature of private capital. It was the complete build out from the early days of private equity to private credit, venture capital, and the full suite of capital tools that allowed CFOs, treasurers, CEOs to actually stay private. And it was the most efficient form of capital, in addition to all the public capital they could get, whether they're dealing in the bond market, et cetera. But it really was just about efficient capital allocation. Along the way, there was a proliferation of private equity firms, and there were extraordinary returns. And if you look at the cycle, all that's really happened over the last couple of years is there was a period of congestion where capital was being recycled very, very quickly. But it's gotten a lot of attention. I actually think at this stage, the narrative is a little stale. If you see what's happening in the industry, the private equity ecosystem, if you think about private equity primary and secondary activity, one of our fastest growing businesses, as you know, is really just in the beginning of creating a more dynamic flow of capital for the entire industry. And I think when you step back, the questions we have to ask ourselves, against the backdrop of a lot of things that have been discussed today, when you think about what's happening geopolitically around the world and some of the big macro trends that we're just living through a huge shift in, going from a deflationary world to a slightly more inflationary world, global cooperation, steep inflection in technology again, the demand for capital of all forms for the next 5, 10, 15 years in the business that we're in is only growing. And everywhere we go in the world, and it was discussed here earlier today, it's about economic growth and economic competitiveness, and the demand for capital will be very high. So I feel quite optimistic. We've taken 4 companies public in the last year, largest privately owned company in Japan, largest private owned company in India, third largest private company, third largest IPO in the United States. The capital is really starting to return to the industry, but more importantly, the opportunity set going forward, because the capital demand is high and we're not seeing a structural change in how companies get capital and how they optimize capital.
That's great. Harvey, you mentioned liquidity there indirectly and speed of recycling capital. Can I go to Joe now, actually? In how do you answer that question from investors? What's your guidance to liquidity? Another statistic that is quoted, Hamilton Lane data, on a run rate basis, this industry on the PE side was delivering 23% of your prior NAV in liquidity on an annual basis. That wasn't the case last year, last 2 years. I'm sure you get this question. What's your guidance? What's KKR's guidance for that?
Well, I think context matters here. So it's hard to generalize about the entire industry because I think the bifurcation of performance is quite extreme today and probably more bifurcated than it's been in the last 10 years. I'll give you a good example. I think what's happening now, some of the congestion on the exit side, you really have to contextualize really around what happened in 2020 and 2021 and early 2022. The industry underinvested in 2020 in the middle of COVID. Capital markets were shut, a lot of dislocation, and the industry didn't lean in enough to deploy capital in that window. In 2021, with the response by governments around the world, the massive liquidity that was injected, interest rates going to unreasonably low levels at that point in time, there was a rush of deal making at high prices when there's a lot of liquidity in the marketplace. And if you think about our private equity business, we're holding companies for 4, 5, 6, 7 years, right? Those deals that were done in 2021 at the peak, if you will, at high valuations with a very aggressive amount of leverage because interest rates are so low, those are the deals that are stuck today in the industry. But again, I think what you're going to see, like the firms that are doing well in this environment are the firms that were very disciplined, I think, in terms of pacing of investment in that time frame 4 or 5 years ago. Our deployment in 2020 went up 40% in the middle of the dislocation versus 2019. And our deployment was flat in 2021, right? So if you look at our US private equity business in the last 5 years, for every dollar we've invested, we've returned $2 of capital to our investors. This year is going to be our big year for Asia liquidity, given the stock markets in this part of the world. Half of our global distributions in private equity are going to come out of Asia, which really speaks to the capital market development in this part of the world you're seeing. So I think a lot of what you're seeing, the context really explains a lot. One of my partners recently did an interview, and she said, how is it that there are more private equity funds in North America than there are McDonald's franchises, right? And it's true, 14,000 McDonald's locations in the US, and more than that in terms of private equity funds in the US. So it's hard to generalize. I think you have to really look under the cover and see how people have invested. And I think today people also talk about the slowdown in deal making and activity. I think people are resetting and trying to get back to basics. Valuations are objectively high today, right? People should be more cautious in deploying capital in this type of valuation environment. And there's no shortage of financing, whether it's public financing or private credit financing, right? And I think you have to be very disciplined in a market like this and focus on what private equity is meant to do, which is fundamental operational value creation in companies, bring better governance to the table. And I think that's how you're going to generate consistently and outperform the public markets.
Thank you. Rob, to you, Joe connects cycle, deployment pace, vintage. From a European vantage point, do you see any difference in terms of the point in the cycle, the level of exits and the outlook?
Yeah, thank you. And thank you, Eddie, for having us back. It's great to be here. I think it's a very exciting time at the moment, I've got to say. I think it's very hard, as Joe's just been mentioning there, to underestimate what we've been through over the last 5 or 6 years as a global economy. It's very easy to forget that come sort of February, March of this year, it'll be 6 years since COVID hit us. All the destabilization, all the volatility since, geopolitical, economic, and actually the resilience of the global economy, but the resilience of the world in which we're in, the alternatives, I think has been pretty astounding in actual fact. I totally agree with Joe that we're seeing a real bifurcation in the industry. I mean, it's always been there, but of course, the more players you have, the greater the levels of volatility within the market, the more that shows through. So, just taking your point about the European outlook, yeah, we are seeing strong flows into Europe, and Europe's always been a very interesting and successful place for private equity investing and alternative investing. I mean, by way of returns over the last decade, I think it might take quite a lot of people by surprise that the net IRRs in Europe over the last decade have been higher than they have in the US. 16% net IRR over the last decade in Europe versus 15 in the US. But it's even more interesting, and the key to investing in Europe, when you look beneath those figures, when you look at the amount of alpha, and alpha's been talked about a lot this morning, and I'm sure will be further. It's very, very important within our world. And if we look at what Europe has managed to produce, within Europe, half of that 16% is alpha. In the US, there have been, we know, very strong tailwinds to the US market, but that has actually meant that the levels of alpha have been 1.5% as opposed to 8%. Now, why is that? Well, the US market is a very active, very liquid market, but it's also a very efficient market. Europe is a fascinating place to invest because of all the challenges and the imperfections that the European market has. And that means that if you have players like KKR, like Carlyle, like ourselves on the ground in those local markets, the ability to produce high alpha, the ability to produce strong returns in that market is very strong. And that is what's really recognized by the most sophisticated LPs and institutional investors out there.
Just to, before I let you go on liquidity, all of you, secondaries was mentioned as well. It's front of mind. Harvey mentioned one of our fastest growing areas. The LP angle here is, are they really exits? One of the issues against Europe was that a big percentage, as much as 40–50%, were actually secondary transactions, not IPOs as much as. Can I have a quick reaction on that? And maybe you might be wanting, Joe, to grow your secondaries business. So, Harvey, can I give a quick reaction of how you think of secondaries? It's a continuation vehicle, a true exit, yes or no?
Sure. So I think one of the things I find quite fascinating is narratives can be quite stale. I think one of the stale narratives is that there's not an opportunity in private equity because exits were slow for a couple of years, and I think my panelist partners here have covered it quite well in terms of the dynamic in the industry and what's happening. What I also find quite fascinating is that secondaries has been growing quite quickly over the last couple of years as a liquidity solution. But the industry should be evolving with liquidity solutions. I actually think this is a trend that's in the very early days, and I actually think it's quite good for the industry because I think the availability of more exits, more efficient capital allocation is only a positive. And so it's one of the fastest growing parts of our business. I think that's a sustainable trend because I think the industry sector will continue to grow. We may see consolidation. I don't know. That was the first time I knew there were more private equity firms than McDonald's. I thought it was quite fascinating myself. But I think there'll be a tail of consolidation. There will always be specialist funds, just like there's 4,000 banks or whatever the number is in the United States, but we think of them as the people that were on the stage earlier. And so I just think that this is an early phase of evolution of the asset class where however you monetize, as long as you're monetizing with the types of returns we're talking about, then I think it's actually more proof of concept versus test of concept.
Yeah, no, that's great. Joe, then connecting, you said earlier 50% of your exit activity was in Asia. Can we go back to Asia? You've obviously built the business here, so you're front and center and it's close and dear to your heart. But how do you think of investing in Asia? How is that statistic? Can you unpack that a bit for the audience?
Sure. Love being back in Hong Kong. I spent 10 years living out here from 05 to 15, building out our business initially. So we've been investing in this part of the world for a little over 20 years now. And I would say at KKR, Asia is by far, at least in private equity, our fastest growing business. And the one where we see the most, I think, unique opportunities in this environment today. And I think that's underpinned by a number of just fundamental trends and tailwinds in Asia. There's been a lot of talk about Korea, Japan, and the real opportunities on the back of corporate governance reform. It's no surprise that the Tokyo stock market and the Korean stock market have gone up dramatically since these reforms were implemented. It's just hard to get deals done, right? But you have large conglomerate structures. You have now CEOs and boards focused on ROE. So they're selling non-core businesses, they're selling non-core assets. And we're starting to finally see a pipeline of large-scale divestitures out of companies. For us at KKR and Global PE, outside of the United States, the largest destination of private equity capital today after the US is Japan. And India is probably top 4 markets as well. So Asia is a huge part of what we do. We have 9 offices in the region, around 650 people on the ground, very localized, and around $80 billion of investments in the ground today. So it's that, it's corporate governance and buyouts, corporate carve-outs. It's clearly the tailwinds around domestic consumption in these key markets. 3 billion consumers, Asia's 60 to 65% of global GDP growth. As that middle class keeps growing, basic things in consumption, value-added services, healthcare, they're all going to be really exciting areas to invest over time. On technology trends, there's been a lot of talk about AI. I think that's really more of a China opportunity in many ways because, Korea, Japan have great technology, but they're short on energy, and you need both. And they're short on land, right? So China, I think, is going to be the real dominant challenger to the US in AI because they have that combination of assets to really scale AI quite dramatically. But in Korea and Japan, I think there is as big an opportunity, though, given their demographics, the aging population. They are really big leaders in robotics and industrial automation. And I think that that's going to be probably the next 5 years, the bigger opportunity for Korea, Japan, than just pure AI applications. And then I'd say the final thing is really around intra-Asia economic integration. Like, that's a big deal, right? Asia is trading more with Asia. China, Japan, Korea, India, Southeast Asia. Intra-Asia trade is just a little over 60% of trade within Asia. That number is probably going to 75%. So when you think about where to invest in this part of the world, betting on the region, I think, is a pretty safe bet long term.
Great. We're down to the last 5 minutes, so I'll ask the members of the panel for quicker answers on the following rounds. But Rob, Harvey mentioned, and you mentioned, Joe mentioned, more GPs than McDonald's. A fellow European, Per Franzen from EQT, said 5,000 fund managers at GPs would disappear in the last few years. Really? What's your take on that? What form could consolidation take? You acquire one firm in secondary space. What's your take from a European perspective of consolidation, and what will be CVC's approach to it even?
Sure. Well, let me just go back 40 years to my first day in the office, Juan, at 3i when I started my career in private equity. Hadn't been invented, so it was venture capital back in those days. And I arrive in the office, and the first thing I'm greeted with is, welcome to 3i, welcome to venture capital. You've just got your timing completely wrong, and the industry's dead. And the reason I recount that tale is because, of course, it was wrong, but also over the years we've heard a lot of times, I'm sure we've all heard, that the industry is finished in its current form. And the reason I make that point is because we should never underestimate how adaptable private equity and the alternates market is generally. And that's what's happening at the moment. We are adapting to a very different world. And it's the ability to adapt so rapidly that is such a powerful part of the industry. And so there your consolidation point, there will be consolidation. And I think consolidation, as Harvey mentioned earlier on, there are going to be winners and losers within this world that we're going through at the moment, the amount of change that's going on. And the bifurcation that we're seeing, it'll all be down to performance. It's always been down to performance. And those firms, I mean, we're all fortunate to be in the situation where performance is very strong. But there are a lot of players out there where performance is less strong. And the LP community is a very discerning and very sophisticated community. And their capital will follow that success. And the stronger will, where they can really bring onto their platforms important and additional aspects, that consolidation will occur. So we acquired our secondaries business, we acquired our infrastructure business, and should the opportunities arise further, no doubt that we will acquire more. But it's also very, very important to say within that it's about culture, it's about scalability, it's about finding real quality so that we can build the businesses going forward. But I'm sure that's going to be part of it. But equally, as Harvey said, there'll be new businesses generating themselves within our environment. And so the environment is just very dynamic. And so I don't see consolidation as being in any way a negative aspect. I think it's a sign of strength.
Connecting, if I may, consolidation with the convergence, also linking it to the previous panel. Harry, you started us off, closed us off on public and private hybrids. We can ask Joe, how's it going? Because you have one. But are you two looking at?
But just to emphasize what Rob said before, I was on a trading floor in 1998 when long-term capital went out of business, and a very senior person was standing behind me. I was just a kid and said, "That's it. The hedge fund industry is over." The hedge fund industry sequentially has grown for almost 30 years since then. So I think to Rob's point, calling the inflection point in any industry, banking, public markets, ETFs, public bonds, these are all very, very valuable tools for capital allocation. In terms of the earlier panel discussion, and I want to leave some time for Joe, I think this is, again, not revolutionary. All of us have worked as fiduciaries for municipal workers, firemen, people in the United States for pension plans, and wealth has been a big part of this industry for a long time. It was one conventional vehicle or a wrapper. So again, I don't think this is revolutionary what's happening. This is just about asset allocation. And I could agree with both Manny in the last panel and with John about the debate around where you're going to get a better return. I think ultimately it's how people think about their own portfolio construction. But this is, again, completely evolutionary. I don't even think of this as particularly creative corporate finance. I think this is just about solving a client problem globally, whether it's wealth, mass affluent, or in the retirement channel where we've been providing these services for a long time.
Rob, may I rudely skip you and give Joe the last 20 seconds? How's it going?
It's going great. I mean, we have an amazing partner in capital, and you heard from Mike Gitlin earlier this morning, so it's the early stages of this partnership, and I think as people have said this morning, this is really about giving individual investors more choice, fundamentally, right? So if you're a doctor or a dentist in the United States, historically, you don't have a big pension plan, so you don't have access to the alts. Really what these products are fundamentally doing is democratizing access to the alternative space and giving individuals just that much more choice. So it's going to take time. This is not going to be a silver bullet, but I think in the next 10, 20, 30 years, you're going to see that wealth channel be a major part of the alts industry.
That's great. And that's a wrap. Thank you so much to the panelists and the leaders. Thank you.
Thank you very much, speakers. Please remain on stage for a group photo. Please now look towards the back for our media friends. Thank you very much. You may now be seated. Diversification. This word has been a buzzword in recent months, but where should we diversify into? From Europe to Asia and beyond, and across different asset classes. The next panel will provide insights into where growth and investment opportunities can be found. The session will be partially conducted in Putonghua. You may use the headset in front of you for English simultaneous interpretation. Let us now put our hands together to welcome our moderator, Bonnie Chan from Hong Kong Stock Exchange, and our panelists, Valerie Botson from Amundi, Ronald O'Henley from State Street, and Zhang Hui from Bank of China. Bonnie, over to you. Thank you.
Thank you, and good morning to everyone. I'm sure everyone has been enjoying the summit so far. And this panel is about diversification from Europe to Asia and beyond. And diversification is a word that we've heard a lot of this morning. In fact, I think it's prominently featured in quite a number of preceding panels. And of course, we have seen a significant reallocation of global capital this year as investors respond to many things, right? From the geopolitical side of things to macro volatility, and also as we see increasing growth and risk management opportunities. So as the world seek for this new equilibrium, shall we say, I think we should just expect this trend of diversification to continue. So I think for this panel, we really want to look into what it means for the different geographical areas. And I have to say, Hong Kong has benefited from it. I mean, you've all heard about how the Hong Kong market has fared this year. It's very refreshing to be referred to as the tip of the spear as opposed to the relic of an international financial center. That unfortunately was a label put on Hong Kong a few years ago. So we're very fortunate today with this panel. And so without further ado, let's get started. And I would like to start with Valerie. So Valerie, we are seeing opportunities arising from the EU's competitiveness agenda. And I think similar to the Hong Kong market, quite a number of European markets have also done very well. The DAX have improved more than 20% year to date. So can you help us understand this? Whether you are seeing, in fact, global investors pivoting more towards European assets, and what does it mean for a firm like yours, Amundi?
Well, thank you very much, Bonnie. Good morning to everyone. Yeah, let me start maybe by drawing very quickly the European political and economic agenda to answer your question. There have been a few initiatives, 3 of them mainly, over the past few months, which I think are very interesting for Europe and we should attract worldwide investors. The first one is the launch of the Savings and Investment Union. The idea here was to make sure that the abundant savings of European citizens can be channeled very directly and very clearly towards long-term investment in order to speed up the competitiveness of Europe and European industry and economy. The second one, of course, is around defense. You may have heard about it. EU increased its financial commitment by multiplying by 5 the budget in the European Competitiveness Fund, the defense budget. And as you probably know, we also have European countries which we committed to invest 5% of their budget in defense by 35. So this will obviously increase the valuation and the dynamic of defense companies in Europe. And last but not least, Germany, which was known for its very strict fiscal orthodoxy, has launched an ambition, a multi-year plan to invest in infrastructures. So I think all these three initiatives are going to be very good for the economy in the short term, and will be, I would say, speeding up the valuation of some company. And if I may add, two more structural reforms which are being handled on the financial area. The first one is around pensions in Europe, which is transforming everywhere. You know that the population is aging worldwide. It's specifically true in Europe, and the pension system is being reformed country by country, sometimes in a different way, but all the time with a clear vision of feeding long-term investments toward Europe. And retail participation to markets as well is being very much encouraged. For all that reasons, I think we should be comfortable and positive about the future of European economy. And we have been seen already and will go on seeing investors from all over the world participating to this growth.
Thank you. So 3 initiatives and 2 structural reforms. In fact, I always tend to think about Europe in a similar fashion as Asia, because, you know, I think both regions, we see quite a lot of fragmentation over the last few years, and therefore, if there's a chance to really have all the, you know, different countries and markets within that region, you know, joining hands, that should create a much stronger momentum. So with that remark, maybe I'll turn to Mr. Zhang Hui, and I'm going to ask this question in Mandarin. So if you need translation, please do use the headphones.
Mr. Zhang, this morning, we have listened to the leadership's instruction about consumption. Can we know your view on China's ambition to build a mega-sized consumer economy to boost private consumption? How would that affect your various business sentiments regarding your bank's business, such as retail or institutional business? What kind of impact do you think it would bring? Thank you. You mentioned that China wants to be a mega-sized consumer economy. This is not only a vision, this is also what's happening right now. From statistics, we have already seen that. The first 3 quarters this year have seen a great contribution to GDP from consumption, around 53%. Up by 2.8 percentage points. And our research institute also predicted that during the 15th five-year plan, that this number would increase to 60%. So it would provide a lot of driving momentum to the economic development in China. China has a great population. It consists of great potential in consumption. In the past, maybe the consumption more or less lie in the product consumption. But the next focus would be service consumption and also consumption in some new emerging areas. As you know, that China is also going through a aging transition. have a higher growth of GDP per capita than the overall GDP growth. And the second part of your question is about the impact on our business. In the first 3 quarters, the individual consumption loans increased by 26%, and in the service area, 17%. And this has already exceeded the growth rate of our asset, which is around 7%. So it has provided a very good foundation for our business growth. We will protect this opportunity, and as you know that BOC is an internationalized bank, and we also want to utilize our role in 37 countries and regions. We already provide individual business and services to the greater Chinese community in 37 countries. And as we know that there are lots of convenience for foreigners visiting China. So now we have the tax refund business in the 19 provinces and autonomy districts. And these can provide great support for tourism in domestic markets. And we can also provide different kinds of consumption loans and financing to guide or tap into the potential of consumption. On the supply side, we would focus on service-related consumption and new retail consumption, and will provide financing support. So we can cover both the supply side and the demand side. On the other hand, we can provide asset management service to the individual consumers to enhance their capabilities to spend. So we will grasp that opportunity on that front. Thank you, Mr. Zhang.
This topic of consumption is an interesting one because, we were earlier talking about diversification. And, from my vantage point, when I look at my pipeline of companies waiting to get listed on the Hong Kong Stock Exchange, I would say half of them are in the new technology space. So a lot of biotechnology companies, specialist technology companies, AI, energy transitioning. But also quite prominently featured is new consumption, what we call new consumption, and the idea of intellectual property. Companies focused on really developing an equity story out of that concept is a growing part of the pipeline. So, I guess we should monitor that space. So let me now go to you, Ron, and let's maybe go back to the more traditional asset classes or things which investors generally consider as safe havens, U.S. Treasuries. Do you think that's really challenged as the ultimate and primary safe haven asset? And what do you consider as alternatives? Over to you.
Well, firstly, let me just thank the HKMA for yet another great convening. And your question, Bonnie, really is, I think, about U.S. Treasuries embedded in it. Is the U.S. still a great place to invest in or not? And certainly that bet has been a great bet for a very long time. If you think about performance, both equity and the Treasury markets, it's been a great place to be. And it's actually really hard to question that even now when you think about the performance of U.S. companies, the profit levels of U.S. companies. But it is a different moment right now. We've got this, you can call it what you like, you can call it a reordering, you can call it a deglobalization, you can call it a reglobalization, but both in trade and capital flows. Secondly, you've got a fiscal situation in many parts of the world, really driven by sovereign debt. The U.S. isn't the only one, but it's certainly in terms of the sheer volumes. We have a debt situation there. And we've seen, certainly we've seen the rates on treasuries go up. And the question then becomes, is this and when you see what's happening with the dollar, is this a de-dollarization or is this a depreciation in the dollar? And I don't think we know the answer yet. My own view is that it's going to take a long time to de-dollarize. I'm not sure it'll happen, certainly in the careers of many here. But I think that the role of the U.S. and treasuries and the dollar has been, is being challenged now. But the point that I think you have to make is, how do you think about it going forward? It's been a great bet in the past. How do you think about it going forward? And while the U.S. administration isn't always the clearest communicator, I think what's the policy embedded by all the tactics that you're seeing is one of growth, and a belief that if sustained growth can be kept at or above the 3% level, that the debt situation actually takes care of itself. There's been an agenda here. The first, and we can disagree with it, but here's the agenda. The first has been around tariffs and this idea of let's bring manufacturing back to the US. The second thing has been about taxes. And the third has been about deregulation. The administration more or less started in that order, but now it's going on all three. And to the extent to which you believe that that can make a difference, I think the challenge for the US is that overlaying all this is an immigration policy that I think actually can be anti-growth. And if you look at the US over really almost its entire lifetime, it's been fueled by immigration. In modern times, US demography would look a lot like European demography, but for the fact of immigration. And we don't have that same level of immigration any longer. And it's not just illegal immigration that's being stopped, but legal immigration, including the kind of immigration that's really driven a lot of growth, a lot of prosperity, a lot of company formation in the US. So to me, the biggest challenge to all that we're seeing in the US will be what happens in immigration, and do we have, what kind of policy emerges from that? Right now, there's not a clear and coherent policy. So having said all that, to finally get to the answer to your question, I do think that treasuries are, it's going to take a little bit more to spur buyers of treasuries. The US is unlike Japan, where lots of government debt is basically bought internally. Most of the US government debt is bought externally, and people and investors will be seeking a yield.
Thank you. So the jury is still out whether we are seeing de-dollarization or a depreciation of the US dollars. Now, this clock is ticking rather fast. So I would like to ask a perhaps impossible question of all three of our panelists, which is, reflecting on everything that we've heard today, and the theme of this summit, tracking the shifting terrain. So just imagine you have the magic wand and you can put together a perfect investment portfolio, and let's put a time frame to it, right, for the next 12 months. What geographies, asset classes, combination are you going to put your money on? We'll start with Valerie and then on to Ron and then finally Mr. Zhang.
Well, I think that, as you know, we have at Amundi, we are a leading European asset manager. But we are based worldwide, and most of our clients are either European or Asian. So I will answer with this important DNA that I share with our European and Asian clients. What I see is that they're all questioning their US heavy exposure today. First, they've been reassessing their aging strategies recently, considering the dollar topic we just mentioned. And when it becomes too expensive, they're really looking for diversification, which is what we really, really advise them to do. Speaking about Asia, I think that globally Asian assets are very well positioned. The valuations are globally attractive when we compare them to in a worldwide area. Of course, you need to be selective, but Asian assets for us are a must. In Europe, I think investment-grade corporate bonds are interesting, and when we speak about equity, we always look today mostly at quality business and valuation. If I had one advice to keep is to switch from a market cap weighted portfolio to a GDP weighted portfolio. I think it's the best way today to be clever in diversifying your portfolio.
Well, I like that answer because, you know, that's a little biased towards Asia. Ron, over to you.
Yeah, I'm not going to focus on geography. There's been a lot of talk here and at every conference we all go to about AI. Is there a bubble? And it really is, if you think about where all the investment is, it's in effect been about the infrastructure and the hardware. I would be highly focused on trying to figure out who are the companies that are actually going to apply it well. The application really is in its early moments here. And for good reason, because to actually do it right, one, you've got to get your data right. And that's a combination of getting your data in order and then putting the right risk and controls around it. Secondly, then, you've got to get your processes right and re-engineer those. I mean, there's no point in automating the crooked line, as they say. And then thirdly, actually then apply it. And to the extent to which you can figure out who those companies are, and there's no reason why they should be geography bound. So I think you'll see new champions emerge as a result of this. We were talking about beforehand in the session, I actually think that for all the money that's being invested in the hardware and the enablers and the infrastructure, I don't think it's going to be the same level of investment to actually apply it. And so that's what I'd be thinking about. Who will be the new champions that are going to disrupt existing industries? Some of it will be new disruptors. Some of it will be incumbents, though. They're going to figure this out quicker than their competitors.
Yeah, that's certainly what every one of us has to think about all the time recently. So finally, over to Mr. Zhang, 一个完美的投资组合。
Perfect portfolio. What are you going to allocate? I think from the banking perspective, we are more concerned about the allocation of our business in different geographies. We have all along been international. When our internal environment has been changing and globalization has also impacted on our international efforts. So I can give you some figures. You would know that right now we have a low interest rate environment and commercial banks are facing a lot of pressure. But because of our international foothold, through our overseas business in relation to the support to our revenue and also profit, there is good hedging. In terms of geographies, we will focus on Hong Kong, of course, which is our base camp. We have been deeply rooted in Hong Kong with great level of influence for many years. We will further expand our investment into our business in Hong Kong. It's my first time to come to this summit, and that has consolidated our confidence further. We are together with many financial leaders here talking about the future. This shows how vibrant Hong Kong is. BOC Hong Kong is a platform that faces the rest of the world. And a number of years ago, well, I think 8 years ago, we have started the construction of our regional headquarters. By leveraging on the Hong Kong platform, we have been radiating our business to the rest of Southeast Asia. And this region provides very good support to the BOC's operations, and the regulators have widely recognized our efforts. So for the next step, we will deepen our roots using Hong Kong as a platform to expand into more places in Southeast Asia, and then also in Central Asia, Middle East, and also Europe. These will be our important targets looking ahead. Today, we also talked about AI investment. I think we are more concerned about investment through the LLM, but we need to shift our attention to AI plus, how it supports our industries. In what areas, through effective use of AI technologies, we can create explosive growth in our industries. I think that is the right focus. Thank you.
So unfortunately, time is running out, but I'm sure that all of our guests have really enjoyed this conversation. So once again, let me thank Valerie, Ron, and Zhang Hangzhang for your time and insights. Thank you very much.
Thank you, Bonnie, and our speakers. Please remain on stage for a group photo. Please now look towards the back for our media friends. Thank you very much, our speakers. You may now be seated. Thank you. Digitalization and urbanizations have profound impact on our cities and infrastructure, particularly for the demand, generation, and transmission of energy. This panel will discuss the outlook of this sector and how investment in it could shape a more sustainable future. Let us give a warm welcome to our moderator, Neo Shen from HSG, and joining him on stage, we are delighted to have Jim Coulter from TPG, Bruce Flatt from Brookfield, and Shamara Vikramanayake from Macquarie. Neo, thank you. Over to you.
Well, thank you. I'm glad, very, very glad to be here, and this is my fourth year attending the event. Congratulations to Eddie and the HKMA team to putting together another amazing event. I think today's topic for this session is about new energy, but broader base infrastructure. So we have a great panelist here. I don't think we need any introduction. Jim, Bruce, and Samara, I think has been actually recently hit some headline news with their respective investment in this segment. So let's start from AI, because many of those demand for energy and for new energy are actually driving because of the AI. I think tremendous of increase of capacity. So I'll start by asking Bruce. I noticed that you actually were speaking about AI data center just about last week. Yes, you were saying that we can't build enough data centers. So what's enough for you? Your research paper published recently was calling for a 75 gigawatt of AI data centers for the global. And that means 7 trillion investment. That's a lot. So, sort of what's enough for you, and do we have enough demand for that? Because we will heard a lot of comments in the early panel about, oh, there is this bubbleness in the AI investment in journals. What's take on that?
Thanks, Neil. Thanks, Eddie, Howard, Sampson, for having me. I'd start off by just saying I think the perspective has to get changed a little. Before we built railroads, highways, all the infrastructure, water systems of the world. And what countries and companies are now doing is laying the backbone of the advanced digital economy that's coming. And when you put that into perspective, what needs to get laid down is that layer of infrastructure across the world to be able to drive business over the next 5, 10, 15, 20 years. And I think that's really what you need to put in the back of your mind. We're just laying the backbone of infrastructure, and all we've ever done in our business is just build backbone infrastructure around the world, and this is just the next layer of infrastructure. And what's really important to recognize is that it's very difficult to do what's going on. And the easy sites for data centers have been used up. Like literally every site 3 years ago that we had entitled was 100% contracted. And now it's hard work to find the next ones. And the good news though, and this is where there isn't a bubble, because every single one of those is contracted for 25 years with the best counterparties in the world. And those today are either sovereign credit, so we're leasing it to countries, or they're hyperscalers with trillion-dollar-plus market capitalizations. And that's what's different. When fiber was laid down and everyone said we had Global Crossing going to go bankrupt, and it did, there was nobody leasing the fiber. What's different today is these are all, virtually all let on 25-year contracts. So I think we've got a long, long runway to go in this, and the inhibitor is power and execution capabilities. So it's not capital.
So you're basically alluding to that hyperscaler has such strong financial power, and they have cash flow able to support it. And that's something you are better on.
Yeah, these are 100% let often to very well endowed organizations which are driving enormous profitability within their businesses today, not from artificial intelligence, that hasn't come yet, but they're investing today.
Legacy cash flow.
They're spending $500 billion a year. Let's say for the next 5 or 7 years, that's $2.5 trillion. In the context of their businesses, it's not that much. And what that is laying the foundation to be able to deliver enormous profits a decade, 15 years from now. And if this all works out, these are going to be $10 trillion companies.
Looks like a good math. All right, Samara, so while Bruce was talking about not enough, you are also selling those data centers. You had actually some wonderful exit, right? I mean, last year you sold AirTrunk for $24 billion. This year you just sold another major data center for $40 billion. I'm pretty sure you have your LPs or your investors must be very happy about that. Are you also put the money back to that space? I mean, and tell us how you look at that space back many years ago when you building those data centers.
Yeah, and look, Ben Way, our head of asset management, is here with me, and we've had a few people asking us whether we've been calling a bell at the top in terms of data centers by exiting a portfolio here in Asia for 24 billion, as you said, last year, and then one in the US for 40 billion. But what I would say, I mean, there's been some really interesting perspectives given by people here both ways in terms of the growing demand, but then also the challenges with increasing technology with compute capacity and things, and will the demand be there, and the small group of off-takers there are. But I would say basically these exits reflect more the fact of the role we play in asset management, which is we start at the early stage and take things from about the zeros to the 20s, and then there is other capital that is well positioned for the 20 to 80 phase and other for the more stable 80 to 100. And so, you know, when we invested in AirTrunk, we took it from 450 megawatts to about a 1.8 gigawatt portfolio, 11 sites. We took it from Australia and Hong Kong into Japan, into Singapore, into Malaysia, and then we exited at a point where the capital required to keep that journey going was beyond the scope of our funds. And the same with Aligned, which we exited in the US. I think when we invested that one, I think we had AirTrunk for about 3 or 4 years. Aligned, we were in for 7 years. And we saw opportunity there to start very early with 7 megawatts. We grew it to 1.6 gigawatts of contracted offtake when we exited it. So we're selling a portfolio that it went from 7 million of EBITDA to 1.6 billion of EBITDA. So the people who came in are holding a more mature asset, but still scope for growth. So I think it's the role we play, and in private markets, there are many of us that play different roles. There are much larger funds that hold it through the next phase. The other thing I would say is here, have 5 data center portfolios left. So even though, yes, we did start 7 years ago in this area, we've got a couple still in the US, smaller ones we're developing. We've got one in UK, Europe. But here in Asia, Joe Bay was saying earlier that China is a big opportunity. We have a portfolio in China. We have one in Korea for North Asia. So we still see scope to invest in the area. And the last thing I'd say is this digital infrastructure for what's coming is not just data centers. There's all the fiber optic networks needed for it. There's towers, there's subsea cables. So our portfolio comprises those sorts of assets as well to support this transition that's happening. And particularly, I think, you know, those of us here are focused on the Asia region for these sessions. And we have 50 portfolio companies in the Asia region. We think there's a lot of scope here, particularly with lower risk to keep investing.
Great. And Jim, I know you're also building massive data centers, but I want to ask you a different question. I mean, we all talk about massive capital, but what about human capital? What are the technologies going to make a difference in building those data infrastructures?
So I'm an investor, and it's always critical to get the questions right. And that question is interesting to me because no one's been asking it. So let's think about the questions we've been asking. Is it going to be big? I think we'd all raise hands. This is going to be big. Is there enough money around to do it? I was riding up the HKMA elevator, and the little TV screen said, you know, investors clamoring to get an AI. I'm not worried about money. You're right, Bruce. They've got $40 billion or $20 billion market cap. They can borrow $2 billion to do data centers if they need to do it. And is there going to be a bubble? We've asked that 5 times. Of course there's going to be a bubble. There is in every major. The idea that the market would totally land this perfectly is of course wrong. But here are the questions that are much on my mind. The sheer physicality of this, as you're talking about. So the biggest thing in real estate right now is Jamie Dimon's new headquarters. $3 billion in New York, it's taken 10 years, articles everywhere. I'm sure you guys are doing the same thing. We have one project in Texas that is $40 billion that we're spending in the next 3 years. No one's written a single article about it. How is that going to happen? Or if you go to the high level, the 10 biggest energy companies in the world outside of Aramco are $2 trillion. Data center spending over the next 3 years is going to be $2 trillion. If data is the new oil, we've got to remake the entire energy business in the next 3 years. Like, how is that going to happen? And the question, I don't have a good answer, but if you ask that question, if you figure out how that's going to happen, there is massive opportunity. The second question behind that, though, that no one's asking is like, who's going to do this? All of you are looking for AI advisors. I moved in high school. The first people who want to be your friends are not the people you want to be friends with. If they are advising you and they're really good, they should be in San Francisco, because I can tell you that's where it's happening. There's $200 million pay package if you really understand. Likewise, you guys know there isn't the human capital to build a lot of these data centers. The old data centers are real estate plays. They were just hook it into the energy, hook it into the trunk. Like, these are total, we're building massive energy malls. There's only a few people around the world that these large hyperscalers are going to trust to do it. And then, are you even thinking about it right? We tend to think by asset class. To understand what's going on, you've got to have technology, you've got to have chips, you've got to have services, you've got to have a supply chain. So this is a massively complicated set of questions. And we keep asking the same question over and over again, where the benefit is going to be in these questions that were maybe not even asked. So if you go away from this, I hope you'll actually take some questions home with you, because I certainly don't know the answer, but one of the great techniques in investing is to buy complexity and sell simplicity. So if we can buy the complexity of this market and figure out the simple answers, you know, that's the key.
Great. And we all knew that, you know, energy is a key bottleneck of that AI ramp up, right? So Jim, I mean, when TPG Rise gets set up, you talk about green transitions, new energy investment, but clearly with the tremendous growth of AI demand, you're not just looking at new energy anymore, right? So, we heard some new buzzword, nuclear, which was not the case back 2 years ago when we went talk about solar and wind. So what are the pockets of opportunity in the new energy space that you are most excited about? Or broader-based energy?
All three of us will have a lot to say about this, but there's been, you need to first of all start with a totally different mindset than we all had a few years ago. So let me just go through the mindset shift that is happening. First of all, we were talking about energy transition. The key now is electricity addition. Energy and electricity are not exactly the same thing. As you guys know, in an energy transition, heat is important. Electricity has different attributes and has different winners in that. Second thing is we were all focused on policy up through August, like what would they do with grandfathering? This is no longer about policy. This is totally about practicality. And it is no longer a religious debate over whether it's fossil fuels or not fossil fuels. It's essentially all of the above. So, you guys have a great deal going in nuclear. So it's nuclear, it's everything, because we are short electricity in the world for the first time. In the US, we haven't been short in a long, long time. And so the entire mindset has changed. And we now are going to see, just back to my sizing of this, the three biggest electricity companies in the world have a combined market cap of 200 million. And we're going to spend 200 million on the electricity market each year for the next 5 years in the US. I have no idea how this is going to happen, but it's going to be interesting.
Great. So Bruce, back 2017, you bought a company called Westinghouse, which just came out of bankruptcy. Today, it's a company was just announced last week, is entering into an $80 billion contract with US government, right? You're going to build a massive nuclear reactors around the world. Tell us about that investment, how that fits into your overall energy portfolios.
So we have been for 30 years one of the biggest builders of power plants. We started in hydro, we went to wind, we went to solar, and in 2017 we saw an opportunity to buy a nuclear company at a value which was how much you paid? Which was a value-based purchase. We put $1 billion of equity up, and we thought if nothing changed in the world, we'd do okay, and if odds favored that clean energy with nuclear was eventually going to come back, we just needed time. And I don't think we could have expected what happened over the last 5 years. As you know, and maybe just to step back on Jim's comments, is almost every single country of the world, but in particular in the United States, which is the largest consumer of energy, the grids are going to need to double over the next 15 to 20 years. The grids are going to double over the next 15 to 20 years. They've been flat for 25 years. That's what's going on. So the US government just gave us an order to buy upwards of $100 billion, but $80 billion to start off. It might be double that of nuclear plants. And the reason they did that is because they recognize that we need to restart the supply chain for nuclear in the United States to be able to build. And we were going to build one plant on our own, finish one in the United States, but we needed 10 to be able to build the whole supply chain out in the United States. So they committed to buy these nuclear reactors in the United States. They're going to give us locations for them on federal lands, and it's going to be really exciting for the sector. But maybe to the point, there's over 1 million gigawatts of power in the United States, and this is 20. Yeah, of total energy consumed for electricity. This is 20. The point being, we need all of the amounts of energy of what's going on because of electrification of industry, of cars, and of data centers consuming enormous amounts. And so it's a very significant thing that's going on in the U.S.
Just to size this, and I'll jump off a second. Why do you get excited as an investor? The market for energy addition has been about 29 terawatt hours a year in the US for the last 15 years. It needs to be 400 terawatt hours for the next 5 years. So we have a market that needs to increase 10 times, and we have high payers coming into it who are willing to pay 2 to 3 times market to get power faster. Again, I have no idea how this works out, but this is a really interesting set of questions.
Great. So Samara, you also put a lot of money into work in the new energy space, right? You just raised a new fund, actually, for that. Tell us, your sort of investment strategy in this new energy in connection with the AI, increased demand.
Yeah, and I think as Bruce said, it's not just AI, and Jim said it as well, everything is electrifying now. So together with population growth, urbanization, all of that, these new trends of electrification of transport, everything is driving very big demand. And I think, sadly, we're dealing now, I know previously we had a sustainability climate focus on this, but we realize now we have to thread the needle between availability, the accessibility, and also the affordability of energy sources together with dealing with the climate impacts of it. And that is a difficult needle to thread, but it's going to need massive investment, not just in generation, which is what we've been talking about, but we need a lot of investment in midstream infrastructure as well. Grid capacity is constrained in just about every market. We're in transmission, distribution, also pipeline networks. So I think it is a big area that's going to need investment. The regulatory frameworks play a role in a bunch of this investment, especially bringing on new technology where they have to catalyse private sector investment through some support, but then also the planning approvals, etc. So having a good glide path for each country is important. So I think we work also with the public sector in most of the regions where we're operating in to try and think about that glide path and what role our private capital can play, but we're going to need a huge amount of capital, expertise, etc. to deliver this.
Thank you. So let's go back to the legacy infrastructure investment. Bruce, so you also invest heavily into commercial real estate globally. What is the dynamics there? Do we see that market coming back as people back to work? What's your take?
So real estate in general, it's a cyclical business. One should always remember that. And there are two things that happened this time versus others. Interest rates went up quickly, and their mindset changed that people were not going to go and be in places. I think those are the two fundamental things. Each cycle is different, and this time it was those two. On the opposite side, fundamentals of most real estate in the world, Hong Kong a little different because the leases are short, but in most other places of the world, fundamentals are really strong. So you have underlying fundamentals are strong. What happened was the psyche of lenders and buyers got messed up, and interest rates went up quickly, and that affected financing. What's happened now is that interest rates are coming down. Everyone understands. Everyone's going back to the office. And all other forms of real estate are in excellent shape. What you've seen now is in most cities in the world, there is no construction going on, and there is no space left, and rents are going up. Rents have doubled in New York in good buildings, and they're going higher probably by another 50%.
What about Hong Kong? You're here, so what's your outlook for Hong Kong?
Yeah, so Hong Kong, here's what I'd say. There are greater experts in this room on Hong Kong real estate, but I'll make one broad observation. This is in all value investing in real assets, but in particular in real estate. If you have businesses or cities that are great places, Hong Kong qualifies. And if you have a tough market where things are down, they come back fast. And Hong Kong's turned, and there's very little construction. It's a very constrained place, and real estate values here will come back and be at their peaks at some time in the future.
Great. I hope that future is very close. All right. So
I wasn't talking about your apartment.
Okay. So one last question for Samara and for Jim, right? So we talk about data center, energy, it seems to be that we're assuming there's unlimited capitals available out there, right? But in reality, who's going to fund those big investments? We knew that institutional investor has always played a very important role, including the sovereign wealth funds. But is retail have to be part of that picture, and how we look at that sort of, the supply side of the capital?
Okay, sure, I'll go first. So look, basically there are hundreds of trillions of pools of savings in individuals, in institutions, in governments out there in the world, and I think what we do as asset managers is we connect those savings with investment opportunity where we have expertise to deliver superior risk for the return. What we've been seeing is that pools of saving moving much more from markets like equities and fixed income into private market type assets, the less liquid assets. And that is happening initially through the institutional channel, but now through the retail channel, there are growing mechanisms, intermediated wealth, or now we talked about the 401ks in the US to allow retail to access this. Also, insurance is looking to allocate more to these higher return potentially, but more illiquid and maybe more complex risk assets. So I think what we do is act as intermediaries where we each have our expertise to bring those pools of capital to investments through unlisted markets, listed markets. I mean, Bruce, you have a structure with listed entities at the top using listed markets. A lot of people use unlisted. We're moving more into insurance and wealth. And I think basically, the allocation overall is shifting where people are getting more comfortable taking the risks. Now, we do have to think about the illiquidity risk, particularly as we do this with unsophisticated investors and make sure they're looked after as they go into this. But I think we are seeing more allocation to private markets. And I'll let Jim have the last word.
Jim?
Watch the private markets here. If you remember the 2000 tech bubble, we were actually right that the internet was big, but too much money was trying to go into it. 20 pounds of money was trying to go in a 5-pound sack. Same thing might be happening in the public markets now. But while that public market bubble happened in 2000, over in the private markets, we were creating Amazon, Google, later Facebook. So the business models are what to focus on here. Who has the best business model? If there's a good business model, capital is not the thing I worry about.
Great. So we're running out of time, and let's put our hands together and give this three panelists a round of applause. Thank you.
Thank you very much, speakers. Please remain on stage for a quick photo. Please look straight to our official camera. And now it's towards the back for our media friends. Thank you very much, speakers. You may now return to your seats. Technology is set to transform the financial sector. Our next panel will explore how the latest innovations will disrupt and revolutionize the way financial services are delivered and what the future holds for industry as a whole. Let us give a warm welcome to our moderator, Ernesto Torres Cantu from Citi, and our panelists, Jenny Johnson from Franklin Templeton, Danielle Pinto from JPMorgan Chase, and Bill Winters from the Standard Chartered Bank.
Very good. Good afternoon, everybody, and thank you, HKMA and Eddie, for another wonderful event. Being in Hong Kong for 123 years, actually, city, we've been, witnesses to its transformation, its innovativeness, and adaptation, which is certainly happening again. And talking about technology, and given that during all morning we have not spoken about AI, we wanted to take it to Ron's comment, to the applicability, more than the evaluation, et cetera, in that sense. And let me start with Jenny. No? Jenny, how is AI transforming, business operations at your firm, and what strategic considerations should companies keep in mind to stay competitive in this field?
Well, I think if you're not thinking about how AI is transforming every part of your business, you're not thinking broadly enough. And I almost think you have to think, what is AI not going to do in my business that we can add value by doing? And so, the challenge always with technology is the first thing that anybody looks at is you make more efficient what you do today, you get the tool in the hands of your employees, and then they start to give you ideas about how you can really make the next level of change. So right now, we're at that stage of figuring out, okay, how can we be more efficient? RFPs used to take us 18 hours to do the first draft. It's 14 minutes now. From our investment teams, if you think about it, an investment team has 3 decisions: buy, sell, size. And so we've created models within our investment teams where you put in the team's philosophy, you're looking at historical trades and data, and then as you're making decisions, it actually can challenge the investment person. So the research analyst, well, you actually say this, but now you're recommending this because there's always biases. On distribution, it's about how do you optimize the time of your salespeople? So who are they visiting, and are they having the best conversation? And all that, you obviously have the data internally to provide those insights. It takes time to hone the models, but we're looking at, really every part of our business, and obviously technology, creating code, every part of our business to try to push it forward to leverage the technology.
Thank you, Jenny. Daniel, in same concept of applicability, and also how do you see them evolving to just a productivity enhancement tool or more than that?
So I think that as a big company, traditional company, so the way to succeed, in my view, is to look at, as Janie said, every part of a company will be challenged or transformed. But then how do you think about it? In my view is you have to think if that piece would have been AI native activity, how you would do it, and then try to get the organization to move exactly that way. So we started investing in AI like 10 years ago, and the bulk of last year, we do measure the value more or less, and we got around a couple of $1 billion in value, either cost savings or losses being avoided or revenues being produced. And that number is been growing roughly at 30–40% a year. And I think that it will accelerate. But the bulk of what has happened so far is traditional AI. We are now seeing the beginnings of the increasing productivity driven by large language models. And probably the next step will be agents and how those are going to increase not just productivity in operational processes, technology, call centers, but things like in research, enhance the capabilities of our researchers, in bankers, particularly junior bankers, that they can become a lot more productive and go and face clients a lot sooner. That instead of doing presentations that can be done or filing things that can be done by technology. So I think that this is very transformative. I think that increasing productivity will increase the ability to customize client experience, develop products, target marketing, create client experience where the client group will be one client, and to make it really make the best for that particular client is going to be very transformative. And we are essentially at the very beginning. So I see a lot of growth, top line and bottom line going forward.
Bill, and I see you agreeing with Jenny's and Daniel's comments. No? Do you see the impact in the medium term, like it has been suggested in other panels, etc., or short term and immediate?
Past, present, short-term, medium, and long-term. I think all of the above. I do agree with Daniel and Jenny on everything that they said. I think including the fact that we were engaging in AI before we called it AI. We called it data analytics, and we used it for fraud protection and transaction monitoring and name screening and the sorts of things that large language models were very useful for. But I think like a lot of us in the corporate world, we got excited about the technology, and you go back 2-3 years, we looked around the bank and we had thousands of data scientists and literally hundreds of AI use cases. And we then took a pause and said that's probably hundreds too many, given our ability to focus on a few things that really matter. So I mean, the approach that we took at Standard Chartered was to say, at our core, we're a bank that focuses just on two things. We're actually quite simple. We focus on the cross-border needs of our multinational clients, whether those are financial institutions or corporations or governments, and we serve the affluent populations in the markets in which we operate, which are mostly Asia, Middle East, and Africa. And my challenge to the team was, how many of those 400 use cases are existential for those two sets of activities? If it's existential, we better develop it ourselves and be very good at it. If it's not, we can get it from somebody else, or we can wait a little bit and develop that ourselves. So it's been hard to train people in on 7 to 10 top priorities for us rather than 400. And I can tell you the 400 would have gone to 800 within a year had we not channeled a bit. Now, we'll get to the 800. Many of those you can get off the shelf eventually. It might not be absolutely best in class, but it doesn't matter if it's not existential for us. If it's existential, like my nightmare, and I find our head of retail is sitting in the room right now, the nightmare for me is to wake up one day and find some really zippy fintech who's built a much better robo-advisor that can displace our RMs in an RM-led wealth management distribution model, which is highly successful for us. So if that's your nightmare, then you better have something that is keeping pace with the nightmare. That's what we've done. That's what we're doing. So we've got an excellent, I call it AI augmentation tool for our relationship managers to make them, position them as best in class. And at some point, as appropriate, we'll expose our clients to those tools, but only when they're ready for it and when we're ready for it, which is not today. That's the medium and the long term.
Very good. Thank you, Bill. Now let's move on to the other big trend, stable coins and digital assets. Jenny, you've spoken quite a bit, and clearly about the potential for tokenization and blockchain technology to transform financial services and your industry in particular. What operational challenges need to be addressed to truly unlock its potential?
What operational challenges? Well, so number one is that you have a bunch of different blockchains out there that aren't all integrated, so integration's one. Number two, so we rolled out a natively on-chain tokenized money market fund in 2021. We were fortunate in that we picked a chain, Stellar, that optimized what we were trying to do. If we had picked other chains, it would have been much more expensive, potentially more expensive than our existing money market funds. So you got to pick the right chain. There's some people that are concerned about the number of transactions per second, but actually there's certain chains that are optimized for that have that are faster than even Visa and MasterCard process. So you're working through a lot of these. But the biggest issue is probably most people don't have a wallet. You can't really hold a token if you don't have a wallet. I'm always hearing about alts managers say, can't wait till blockchain can democratize alternatives. The reality is that technology exists today. You don't have market makers. You don't have the infrastructure around it. And honestly, today, there's almost two worlds. There's the TradFi, the traditional finance world, and the digital asset world, and they're only now beginning to kind of come together. And as that happens, a lot of the traditional learnings that have happened will be brought over and much more professionalize, I think, what's existing in the digital assets. But there is no question, I fundamentally believe the infrastructure and plumbing of financial services will be replaced by blockchain.
Quite a statement. Daniel, your firm's perspective on digital assets has evolved significantly in the last years. What prompted that shift or change?
The reality that it hasn't. So obviously, you know Jamie's views on Bitcoin, that is, and he was very clear, these are personal views. For me, Bitcoin is transforming into an asset class. My concern about Bitcoin was more about if you start losing keys, so keys get stolen, it's going to destroy the confidence of this as a class. The reality, a lot of keys were lost and stolen, and here we are. So it just became an asset class that is never been is a place to store value if you believe that you will sell it at a higher price than it was. It's not a method of payment because it's slow and expensive. So it is what it is. And I think that in the big scheme of things, Bitcoin is very relevant. But the technology is, I've been working for many, many years. We launched the JPMorgan coin in 2019. But everything that the industry have done is even private networks like the JPMorgan coin. That is a very, very effective tools for clients to optimize the flows of funding, program payments, and do instant effects. And many clients are using it, working very well. We have done with Bill and other banks the Partior program that is a 24/7 network of transferring payments among banks, led in Singapore. So we have done quite a lot. And right now we are at the point where we start experimenting with tokenized deposits, start experimenting into the public chain space that Jenny has mentioned, with essentially white label clients that you are approved your part. It's not that you put your coin there, your token there, and see how it goes. I think that that is the next layer. I think that tokenized deposits is an effective way to make a bit more interoperable the banking sector with the crypto space. The digitalization of assets is going to start growing. The issue in the banking sector is regulation is a big challenge. When you look at the Basel regulation and their interpretation, essentially prohibit banks to be in a public chain because the capital intensity is so huge that it makes essentially not possible to do that. So the Genius Act in the US for stable coins of certain characteristics is not going to follow, apparently, the Basel, so in which case it's possible. And I think that there are a bunch of use cases of stable coins that they are obvious, like cross-border, small value, cross-border payments. It may be a challenge for some of the existing payment systems that exist today, like credit cards or debit cards. So I think that this is, and the technology is evolving. As Jenny said, Bitcoin is super slow. Ethereum is a bit faster but relatively expensive for low-value payments. Then there are other networks that they are evolving that they are very, very fast, but they have other challenges. So as technology evolves, I think that it will be a challenge for the existing railways in payments, maybe a challenge for the way that we trade in markets as it gets digitalized. So I think that is something that is real, and it will take time until banks and the proper regulation for banks to be part of this ecosystem in a substantial way.
Bill, you've been quite outspoken about the potential for stable coins and tokenization. The market is it's small now. What would it take to go to the breadth and depth that you see in the future?
Yeah, the market is small today in traditional finance. It's, there's trillions of dollars trading in the DeFi world.
I think there were $27 trillion last year traded in stable coins. That's more than Visa and MasterCard combined. It's not that small.
Carry on.
Yeah, good answer.
No, that's all good. I was defending your point, Bill.
We always agree. This is a problem. Yeah, there's a ton going on. Obviously, it's anchored in the crypto world, and that's where it started, and it's growing. And as Daniel said, the technology is the same. It ports from the crypto world into the TradFi world. We're at the earliest stage of the incorporation into the TradFi world. And I think it's inexorable. I think money will become entirely digital over a period of time. That calls for an entirely new infrastructure, which is being built. It will grow out of the crypto world. It comes with tons of challenges. And how we get from where we are now to where we're going to end up is a huge open question. None of us have any idea exactly how this will evolve. And I think all of us have a high conviction that it will, which means that we need sort of hand-in-hand cooperation with regulators and with each other in the market to create an infrastructure that's safe. And I'm going to be super sycophantic because, well, for two reasons. One is we're regulated by the HKMA. It may surprise you to know. Our name is on the banknotes. We care a lot about what happens in Hong Kong. And the HKMA has been super progressive in this area. Not because Eddie and Arthur and team have any better idea exactly how this is going to develop, but because we just know it is. So we're going to have to try different things. So tokenized bank deposits here in Hong Kong dollar stablecoins, maybe at some point a structural connection through to the RMB. Obviously not on the agenda at the moment, but it could be, and this would be a really natural place to experiment in that regard. And I think that's the way to progress from here is a little bit trial and error where the errors don't cost you the system. And but the use cases are developing around us in an incredibly fast way. And the non-bank players, of course, I completely agree with Daniel's observation about the Basel rules. I think it's almost insane to allow a financial system to grow out and intentionally keep the banks outside of it. So the one entity that regulators can look through and see through and understand where the systemic risks are building up or where the operational risks are building up, that one, like we're spies, right? That's what we do. We watch markets, we report back to the regulators. It's insane to keep the banks out. Now, the HKMA obviously is bringing us in as progressively as any regulator in the world. Maybe that's going to happen with the Fed. Maybe it's going to happen with, as the Fed and the US regulators promote post-Genius Act reforms. Other places like Singapore are doing their bit. But the opportunity here is to bring the banks into the system in a safe and sound way, lest we allow the system to get too big without decent oversight.
Thank you, Bill. And let me go back to Daniel on that. If we see that moving forward, what does that do to the traditional model of financial intermediation for banks, et cetera? And how are you foreseeing that?
Well, as I said, I think that on the payment side, assuming that there is some way that regulation is not too fragmented, I think that it will have a role, stablecoins will have a role in very fast, very cheap, very effective global payments and transferring money from one place to the other. I think that tokenization of deposits or tokenization of assets, if it gets to a point where it's properly regulated, is within the regulated space and is done at scale, it will change what are the current rails that we use today as in payments for markets. So I think that is way, way, way too early to know, but it feels now that probably the tide is turning from being something that we've been experimenting for years and years and doing little things. I think that now is getting to a point where most likely will escalate and hopefully escalate, as Bill said, within not just in the unregulated space, allows the regulated entities to be an important player. So therefore, if everyone will be safer in that space and we avoid the problems that we normally have when new things come into the market until they settle down. So we will see. It's still a long way to go, but I think that is real now.
And Jenny, how do you see bank and non-banks working together or not enough to unleash the stable coins, tokenization, et cetera?
Well, I'd rather talk about blockchain than just stablecoins, because I think stablecoins is one, it's the current use case, but there's so many other use cases. So just kind of the question on sort of how does this impact banks? You know, if you think about today, what does this technology do? This technology has an immutable record of who owns it, right? So huge amount of money is spent in the industry reconciling data between systems and then reconciling data with the counterparty. There you have one source of truth. You know exactly when it's relevant as soon as a transaction. The smart contract can trigger it and you get paid. So if you have atomic settlement, which means you get paid, you don't have to worry about who the counterparty is because it's wallet to wallet. I don't need to go to JPMorgan Chase to do a foreign exchange contract and worry about who the counterparty is if, one, the counterparty's wallet has been approved, whitelisted, and my token can only go into that wallet, and two, the smart contract kicks off and makes sure I get paid. So there's a lot of toll takers in transactions today that get eliminated once the ecosystem is rolled out. And if you're like a title company to prove that somebody has ownership on a home, and it gets on the blockchain, you don't need to worry about going out and validating that. So I think you have to look at a transaction and say, where am I adding value and where does this eliminate? And it'll take time to happen, but I think because it drives down costs, it's much more efficient, it will inevitably happen.
Very good. And one last question, Bill. You talked about cross-border, and part of this proliferation, if you will, of each jurisdiction constructing its stable coins has a couple of things. It's the reserve currency of one or the other, and its interaction for cross-border payments, etc. How are you seeing that, Bill?
I think that's first of all, as a toll taker, I'm sure that Jenny had me and Daniel in mind.
You know exactly where you're relevant. You'll continue to be relevant in those.
The cross-border payments are the obvious use case because they've certainly for other than very sophisticated institutions, they tend to be slow and expensive, and less and less slow, less and less expensive, but nevertheless not 24/7 real time. So a lot of the use cases today are, for example, port operators who want to get the ship out of the dock on a Saturday, and they don't want to have to wait until Monday or Tuesday when the payment clears. Very, very simple use case, but a cross-border payment. It could also be a local payment. In the absence of any regulation or in the absence of any alternative, those transactions will be, the cross-border payments will be conducted using US dollar stablecoins, right? Because they're there. There's 280 billion of them out there. They're very liquid. The people that care already have a digital wallet. They can use those stablecoins. But that isn't the world we live in. There's regulation, and many countries said, no, you can't, either a bank can't hold a stablecoin, or a user can't use a stablecoin, or you don't have a local license to engage with a local player. And that, so regulation, as is frequently the case, is the protector of the incumbent, and the incumbent is frequently a bank. So we get to charge a little bit more and be a little bit slower for a little while longer. But water makes its way through a rock eventually, even not so porous rocks. Eventually it comes out the back end. By the way, it comes out clean. It's been filtered along the way. And so I think it is, again, inexorable that the digital asset-based or blockchain-based payments will make their way into the real economy. It's just a question of how fast. And we should be more thoughtful, and I think the HKMA is thoughtful, about how we shape that outcome rather than let it just happen.
Absolutely. Well, thank you very much, everybody. One thing is clear from our conversation is that we're not talking about the future anymore. This is present tense transformation in all of these topics. Thank you very much, Jenny, Daniel, Bill.
Thank you very much, speakers. Please remain on stage for a quick photo. Now, please look towards the back. Thank you very much. You may now return to your seats. Thank you very much to all our speakers this morning for their sharing. Lots of food for thoughts as we go into the lunch break. Ladies and gentlemen, please enjoy your lunch, and we'll be returning to the stage again between courses for remarks by the Hong Kong Financial Secretary and a fireside chat. Thank you. Ladies and gentlemen, lunch will be served at your seats. You may remain seated, and your lunch will be brought to you. Thank you. Ladies and gentlemen, we're serving the appetizers. Please get seated. Ladies and gentlemen, we're going to serve the appetizers very soon. You may now return to your seats. Ladies and gentlemen, we're going to serve the appetizers very soon. Please can you return to your seats and enjoy the lunch. Ladies and gentlemen, we're going to serve the appetizers very soon. Please, may you return to your seats and enjoy the lunch. again, ladies and gentlemen. I hope you're enjoying your lunch. May I have your attention back to the stage again for remarks by the Financial Secretary. May I now invite on stage the Financial Secretary of the Hong Kong Government, the Government of the Hong Kong Special Administrative Region of the People's Republic of China, Mr. Paul Chan.
Distinguished guests, ladies and gentlemen, good afternoon. A very warm welcome to the Investment Summit Luncheon. Like many of you, I'm very much looking forward to the fireside chat featuring Larry and Kent. But before we hear from them, please allow me to offer an update on Hong Kong to whet your appetite. History tells us that the world's great financial centers do not stand still. Their success depends on their ability to serve the economy, anticipate what lies ahead, embrace technological advancement, and adapt to shifting megatrends. Hong Kong is of no exception. Today, once again, we are at a moment of profound transformation, one defined by shifting geopolitics, regional integration, rapid technological advancement, and climate challenges. But these are not necessarily headwinds. In fact, they can be powerful tailwinds for those ready to respond with agility and vision. At the heart of our response is an elevated role for Hong Kong as a super connector and super value adder, one that connects market, capital, innovation, and opportunities across borders and regions. That role is being shaped by a few converging forces. First, a global shift from globalization to regionalization. Trade and economic cooperation within regional blocs like Asia are gaining momentum. We see this in the expansion of frameworks like RCEP and CPTPP, and most recently, the FTA 3.0 between China and ASEAN. These developments are reshaping global trade and investment patterns, and Hong Kong stands at a strategic position. Second, many economies are actively seeking diversification, be it economy, market, sources of capital, supply chain, and others. The Middle East, for example, is increasingly looking eastward. Trade between the Gulf and emerging Asia has been growing at some 7% annually over the past decade. And trade between Saudi Arabia and China is expected to surpass that with the West by 2027. These statistics reflect not merely a change in trade flows, but a structural shift in strategic orientation and cross-border cooperation. Third, China's development must be reckoned on multiple fronts. Despite a complex global environment, our country continues to press ahead with high-quality development. The recent fourth plenary session of the CPC Central Committee has laid out recommendations for the country's 15th five-year plan. It has reaffirmed China's commitment to high-level two-way opening up. It has placed emphasis on technological self-reliance with strong support for technology and innovation across the entire value chain. And the deep integration of technological innovation with industry development is particularly noteworthy. All of the above developments are elevating Hong Kong's role as a two-way platform for trade, investments, and technological collaboration. As part of the national strategy, mainland enterprises are being encouraged to go global, in the attempt to reconfigure their supply chain and industry chain. As they do so, they look to Hong Kong not only for capital, but also for a full suite of high-value services. At the same time, capital is floating to this part of the world too. Investors' optimism has grown, particularly since the DeepSeek moment earlier this year, where the technological powers of China surprise the global investment and tech communities, and their valuation is very attractive. Separately, we have noticed strong interest in our capital market from the global south. They are seeking capital to support their ambitious infrastructure and economic development plans. Middle East is a good example. Last year, we strengthened cross-border collaboration with Saudi Arabia, full mutual listing of ETFs, tracking each other's market. Now we will soon welcome the first Middle Eastern company to list on our stock exchange. In fact, our financial regulators have already signed agreements, MOUs, with their respective counterparts for cross-border regulatory collaboration, paving the way for more companies to list here or to do a dual listing on both stock exchanges. Another important development in Hong Kong is our ambition in innovation and technology. Over the years, we have made over $200 billion in related investments and lay out a clear strategic roadmap to nurture technology and innovation as a new engine of growth, from supporting basic and translational research, nurturing startups, to attracting global and mainland enterprises and talent to Hong Kong, and rolling out special initiatives to promote advanced manufacturing. The aim is to integrate technology and innovation with industry development. Our focus is on 4 areas, namely AI and data science, biotech, fintech, new energy, and new materials. And the carrier of this vision is the Northern Metropolis. And if I may use AI, one of the key areas of focus, as an example, to elaborate a little further, we adopt a twin engine strategy, developing AI as a core industry and promoting AI as an enabler to upgrade traditional sectors. We call this AI Plus. Our strategy rests on 6 pillars: computing power, algorithm, data, application scenarios, capital, and talent. Apart from building a supercomputing center and experimenting with cross-boundary flow of data and biosamples from the mainland to Hong Kong, we have been all out to attract leading companies engaged in cutting-edge technologies. So far, we have attracted over 100 such enterprises. This is supported by a vibrant ecosystem of some 4,700 tech startups. Many of them are based in our Science Park and Cyberport. As to talent, we have modified our various talent admission schemes since the end of 2022. Today, we have received more than 540,000 applications, approved about 360,000 of them, and more than 240,000 individuals have already arrived in Hong Kong. Of course, these technology companies need capital to scale. Beyond the full spectrum of funding options available, from angel investors to IPO, we have established the Hong Kong Investment Corporation as patient capital to channel private capital into sectors that we would like to develop, such as deep tech, biotech, and green tech. Ladies and gentlemen, Hong Kong's story has always been one of reinventing itself. Time and again, we capitalize on our unique strengths under the one country, two systems framework and ride through the waves of changes and challenges with determination, agility, and perseverance. Thank you all for walking this journey with us over the years. Your support has been highly appreciated. I wish you all an enjoyable luncheon and a thought-provoking conversation ahead. Bon appetit.
Thank you, Financial Secretary, for your words. Ladies and gentlemen, please continue to enjoy your lunch. We'll be back for fireside chat. Thank you. Welcome back, ladies and gentlemen. It is time for our fireside chat. It's our pleasure to welcome Larry Fink and Ken Griffin, the founders and leaders of two of the world's most successful and innovative financial institutions. From the early days of their ventures to the present, they will walk us through what drove them to start their companies, how they navigated changes and challenges, and what lies ahead of their organizations. Without further ado, please join me in welcoming our moderator, Howard Lee, from the Hong Kong Monetary Authority, and our two speakers, Larry Fink from BlackRock and Ken Griffin from Citadel. Howard, over to you. Thank you.
Of course. Now, good afternoon, everyone. I hope you have enjoyed your lunch. And we have had a full morning of discussion. We are trying to make it a special way to really conclude the very insightful discussion today. And you can see that we have two CEOs who are always in the thick of shaping the markets. Larry Fink, co-founder, chairman, and CEO of BlackRock, and Ken Griffin, founder and CEO of Citadel. Both have moved billions, it should be trillions, and moved the needle of how the financial industry thinks, acts, and adapts. Now, I would go for Larry first. Now, Larry, BlackRock has really grown through multiple market cycles and adapting to changes while holding to a very clear mission. How do you think about staying true to your purpose while evolving the business models and meet new clients' needs? And you are making big moves in acquisitions. And is it a pivot or a modification of your mission? Or how do you sort of explain the different philosophy going through different parts of your building of your business?
Well, it's nice to be in Hong Kong. Thank you, Howard. Eddie, thank you. It's great to be on a panel with Ken. Actually, BlackRock has been invested with Ken since 1995. And I think it's now up to about, what, $1.5 billion that we have. So it's been a great partnership between BlackRock and Citadel. Our mission has never changed. I mean, everything we do, we focus on behalf of clients. The whole ideal is to be, if we could provide a better service to our clients, a more consistent service to our clients, we could ultimately win more share of wallet. And that's how we look at it. So our job is to provide them with information and also having them focus on the long term. 54% of the assets we manage are retirement assets. So I don't really care about the day-to-day travails of markets or geopolitical issues as much as how do we accomplish the mission of trying to achieve a long-term pool of money on behalf of the clients so they could earn the trust of their clients and their retirees. And so as we have expanded from once was it just a bond firm, actually just a mortgage firm when we founded it, to a bond firm, then we used our currency to grow and to be additive. It is probably two big insights that we had over the years was when we acquired BGI and iShares in 2009, we were highly ridiculed. That most people said you can't have passive and active under one common platform. And I said, well, our clients have both of that. If we could provide a unified platform in which we could move across the spectrum of passive and active, we could provide a better service. And then over the last 10 years, we've seen the augmentation of the private markets. And so in the acquisitions that we did was another just a statement saying with now better risk technology, we're seeing more and more clients just move around the liquidity spectrum of public and private. And so to me, this is just a natural addition to what we're doing on behalf of clients. And through that, I mean, probably the biggest reward or feedback loop that what we're doing on behalf of clients is obviously the scale of the firm, over $13.5 trillion of client money. But we went public now 26 years ago, and for 26 years, our compounded return to our shareholders is over 20%. For 26 years compounded return of 20+% for our shareholders. So it's validated both by our clients and validated to our shareholders.
Okay, thank you, Larry. Let me turn to Ken. And now Citadel has also gone through journeys at different juncture, the volatility in 1990s, and then you are now becoming the best or most successful hedge fund in the world. And during these years, was there any moment that you feel that you have to really think of pivoting in terms of your investment style, your risk management, your talent growth, and then or is it that you started off with this vision in mind and then you consistently drive your implementation?
So the hedge fund manager gets to start with his train wreck, is what you're saying.
Yeah.
Because that would be 2008. Let me take a huge step back. So what do we do at Citadel? We manage money on behalf of endowments and pension plans, wealthy families, medical institutions around the world. And it is a pleasure to be here in Hong Kong. Our 35th anniversary was this last weekend. We've been active in the markets here in Hong Kong for about 34 of our 35 years of existence. So it is great to be here as we now start our 35th year of being in business. The business that we're in is absolute return. We try to earn a return that's uncorrelated to the market. So very low beta, very low directionality in the portfolio. And over the course of the 35 years, in general, volatile periods have actually played to our strength. Of course, was the great financial crisis of 2008, when having a very levered balance sheet placed us in a very precarious position as financial institutions around the world. Many banks were enduring substantial losses and were forced to reduce the amount of wholesale funding they were willing to engage in, which caused a number of price dislocations in the market that traditionally had fed our success to become instant liabilities. So I know that there's a great emphasis here in Hong Kong on the regulation of the systemically important banks. That's actually very important to every single market participant. Thoughtful regulation of banks around the world underpins the vitality and strength of our financial system. And it is impressive to see HKMA's constant focus on how do you improve regulatory standards around the world, and in particular here in Asia. So 2008 was our darkest moment, and in some sense, to not try to make light of it, but we went from being in the storage business, owning a portfolio of cheap assets, financed with very cheap borrowed funds, to the moving business, trying to find more liquid assets, less leverage, a faster speed of realization of the alphas in the portfolio. We went from storage to moving. And that did require us to change our mix of strategies. So for example, a much, much bigger focus on the trading of equities or foreign exchange, where you have far deeper and more liquid markets.
Okay. Now, you talk about changing market situation. Of course, you navigate through these changes very well and then becoming what you are today. But we are now, perhaps like sometime in the past, seeing evolution of new asset classes, new phenomena like meme stock and crypto, and the euphoria on AI investment. And you talk about market rationality in the past. So do you see the current situation, the pretty strong investment in AI, so to speak, and really something that really leave the market a little bit less rational, and then how would investor see this and navigate this? And everybody's worried about missing the opportunity, missing the big boom. But again, the valuation, the amount of investment is really mind-boggling. What do you think? Crypto, AI, and all that?
Well, I think markets tend to be most irrational in their extremes, in the heights of a bull market and in the depths of a bear market. And right now, we are very deep into a bull market in many of the major economies around the world. There's a sense that very little can go wrong, and there's great enthusiasm amongst investors. So, in some sense, your speculative fevers, your FOMO, fear of missing out, will from time to time triumph common sense. And regretfully, humans will exhibit the same behavior in a bear market. They'll tend to panic out of very good investments at the very wrong moment. These are the behaviors that we as people have. And again, they tend to be exempt or magnified at the two extremes of the market cycle.
Okay. Now, I turn back to Larry. We just mentioned briefly about the hype about crypto and all of that. I know BlackRock and you have some view about crypto, but you're really into tokenization, and you feel that tokenization has the future. How do you link the two, and how do you see tokenization being something that might rewrite the kind of rules for financial markets and financial transactions going forward?
So most of BlackRock's business is a business of hope. You know, why would anybody invest for a 30-year outcome like retirement, unless you're hopeful that in 30 years the outcome is better than keeping your money in a bank account? And so I look at everything we do is around giving hope. And I do believe hope prevails in most circumstances. You know, if you go back to even the year 2000, and you invested in equities, let's say the S&P, and then there was a 40% downdraft in 2001. But if you invested in equities in 2000 and kept it until today, your compounded return would be about 8%. So despite the financial crisis, despite the dot-com boom, despite COVID, and if you kept your money in a bank account, you would earn 1%. So I just start with that framework that most of the foundation of BlackRock is to try to give hope to people about the ability to invest over a long horizon. And I am an optimist that I do believe all the noise and all the ugliness we read, we actually mitigate most of it as human beings. And I do believe over a long period of time, hope prevails. Now, that being said, there is a role for gold, and there's a role for Bitcoin, which I believe are assets of fear. You own these instruments if you're frightened of the debasement of your currency. You own it if you have financial insecurities, or you own it if you have physical insecurities and worries. So that's one of the foundational issues of my journey in understanding crypto more. But today there's about $4.1 trillion sitting in digital wallets, growing very rapidly. It has caught attention to people around the world. A lot of men and women who are actually fearful of keeping all their money in their currency or storing it in their country where they live. But beyond that, the opportunity for tokenization is probably the most important component of how we are going to see the evolution of the financial plumbing of the world. There's just too many middlemen in so many different areas. Jenny talked about it earlier, but there's just way too many middlemen in the process. And the reality is, if we could tokenize all our ETFs, all $5.3 trillion of our ETFs, and provide that in a digital wallet, you could seamlessly, without fees, going from a digital currency or a stable coin or whatever that may be in your digital wallet and buy bond or stocks. And I believe that is going to be the future. I do believe more transactions are going to be done digitally. with authentication of ownership. Now, obviously, you know, should the whole financial system be on one blockchain? What does that mean? How, you know, how do we protect ourselves? So there are obviously a lot of things we have to address to make that work. But I do see more and more of a future of having more and more financial assets being digitized, sitting in a singularity of a blockchain, and going from cash to stocks to bonds back and forth, doing that seamlessly. And I do believe that that is going to happen sooner, not later.
Well, thank you, Larry. I think that's a perfect entry point for me to do a little bit advertisement for Hong Kong. We have a project ensemble, which are getting some name internationally, which really aims to provide a pretty unified and good platform interconnection for different asset layers and then different payment means, whether it's stablecoin, central bank money, tokenized deposit, and whatever, and hopefully to create a seamless system for everyone. So I encourage you and your firm to really
we'll be standing right
join
next
hand
to you.
with us. And okay, now you both built very successful businesses, and talent, I'm sure, is one of the key things that you would have to consider through your journey. I would like to turn to Ken, and now you hire very bright minds, and I heard some people said that, okay, they proud themselves as being the smartest person in the room, and then they can figure out all the algorithm, all the market situations. But with the advent of IT, AI, and Gen AI, and all that, and do you think eventually AI would take more share of human being in decision making and sort of make your people feel, okay, I perhaps no match for a super AI? And then how do you think talents are going forward in the world of increasing competent AI?
So first of all, if you were in the room at Citadel, you would quickly realize that being bright is just the ante to be in the room. But to stay in the room, you have to actually work extraordinarily hard. The world's financial markets are incredibly competitive. They don't reward just IQ, they reward resourcefulness, they reward perseverance, they reward just good old-fashioned hard work. You know, we'll do about 30,000 management meetings this year to try to understand the business models of the companies that we invest in around the world. That's how we create value for our clients. And an AI engine isn't going to do that. Yes, it can help us to accelerate the research process, but it's not able to displace the insights of our top or even our junior investment professionals. It's a source of leverage day in, day out in terms of the ability to quickly assimilate and gather information. But if you know what everybody else knows, you know nothing that distinguishes you as an investor in the market. Great investors are those who are able to see what will unfold. They can predict what will change, what will develop, what will happen in a way that an AI model is just not trained or prepared to do. So I'm not worried about the job security of my colleagues at Citadel with the rise of generative AI. I do think that generative AI will create value for society as a whole. We see it already in call center automation, in translation of documents, and we do need to prepare to retrain members of our workforce to accommodate this rapidly shifting job environment. But for most people who are engaged in trying to forecast or predict what will happen in the future, it will be another research tool, but it will give you supporting information, but not the conclusion.
So you do not expect AI would lead to a reduction in workforce, at least perhaps not in financial institution like yourself, or whether there would be a change in skill set required to perform the function with the AI assistance?
So we very carefully look at how AI is impacting the market for jobs. And remember that the United States and much of the world engaged in a tremendous amount of labor hoarding during the pandemic. So companies were unwilling to let people go, were willing to let their workforces grow. Remember, we had a booming economy, tremendous monetary and fiscal stimulus, and a moment in time where companies had really strong pricing power, which manifested itself, for example, as inflation. So what you've seen is you've seen corporate America unwilling to shed jobs. Now the economy has lost a little bit of that tailwind, There's a sense today that continued automation and digitization will allow us to be more efficient. And there's no doubt the C-suite, the Chief Information Officer, Chief Technology Officer, has a bigger voice. In corporate America, embracing the power of technology is now willing to reduce the rate of new college hires. You see open job recs really coming down. But this is not due to AI per se, it's due to a reversal of the labor hoarding that's taken place and a belief that just applying technology writ large will allow us to be more efficient and more productive.
Oh, very good and pretty reassuring for some of our colleagues. Now, I would like to, the next part of the question, I would like to turn to we're closer to home and spend some time on Asia. Now, Larry and BlackRock has been a big player in the Asia market for many decades. If you were to give one piece of advice to a US institutional investor regarding the Asia allocation for the next decade, what would it be?
Well, I do believe that the coming decades will be more of an Asia story, whether it is the educated workforce, the work ethic, and the lifting of so many economies here in Asia that will be rising relative to other places in the world. And so with that, you will see more and more allocation to Hong Kong, to other parts of Asia. And I think that's just a natural progression. I think in addition, I expect to see more Asian countries to have a more robust retirement system. Because if you think about one of the fundamental successes of the United States and why US equities typically trade at higher PEs is because the scale of our retirement system, of this Pillar 3 self-directed retirement systems. And that is a fundamental foundation why US equities have done so well. If you just look in Asia, look to what has happened over the last close to now 2 years in Japan, with NISA accounts now having the ability to doubling the size of tax exemption allocation to retirement, and you've seen the attendant growth in Japanese equities. This is a story that we are talking to every government, not just in Asia, but everywhere in the world. For a great economy, whether it is every country in Asia or everywhere else in the world, a great economy means having a great banking system and a great capital market system. And in most economies, you have a strong banking system and a very weak capital market system. And that's one of the fundamental reasons why Europe was so late in rebounding after the great financial recession, because they had a very poor capital markets. And it took them a long time to offset the increased capital standards of banks, and so there was a sucking out of capital. And so for my optimism in Asia is all about the expansion of its self-directed retirement systems here, the opportunity to not only just attract international capital here, but importantly, to have more self-directed investing in your country. What I try to tell everybody, and I tell a lot of government leaders, you don't want your population to invest in your bonds, because that means your population is renting. You want your population to grow with your economy. And the way you grow the economy for most people is investing in the equity markets of your country. And I believe that is going to be the real theme in the future. If we want to broaden economies, and right now we're seeing a narrowing of economies, we're seeing a narrowing. We need to see more, especially in an AI world where you're going to have 4 or 5 hyperscalers worth $8+ trillion. We need to find ways to broaden the economy, and the best way of broadening the economy is expanding the retirement systems for more self-directed opportunities and investing back in your country. And by doing that, you will see wealth that is broadening across the entire economy.
I see. Now, I want to go to Ken on this Asia question, but I want to bring it even closer to home. I know you are expanding your Asia operation, and you are also expanding your Hong Kong office a lot. So I really thank you for that. But can you explain a little bit why you find Hong Kong the place for you to really further explore Asia, and what are the plus and minuses you see Hong Kong in offering a platform for your expansion?
Well, I think Larry just hit on the key point, which is Asia has tremendous human capital. If you look at the global financial leading cities in the world, New York's 1, London's 2, Hong Kong's 3. Why is Hong Kong 3? The depth of human capital here in Hong Kong. And that mirrors the depth of human capital across all of Greater China, whether it's in finance, whether it's in engineering, whether it's in biotechnology. This is a region of just incredible advancement and development, which is creating value for corporations at an almost unprecedented rate. So we've been in Hong Kong now for 2 decades, and we greatly appreciate the depth of talent that is here in this region. The second key element that drives Hong Kong's success from the eyes of a foreigner is that Hong Kong is the gateway to mainland China. We've been an active participant on Hong Kong Connect for years. It's been a huge success story. The combination of Hong Kong Connect, the long-standing relationships with the Hong Kong banking system, and the trust in the Hong Kong judiciary system makes Hong Kong a natural point of connectivity for firms outside of China into both Hong Kong and into mainland China. And then, of great importance, Hong Kong continues to be open to bringing people from around the world to live here and to enrich the talent base of this region as need be for firms that are growing quickly. So if there's a particular expertise and we need to hire somebody who was born in Australia or who was born in Western Europe, we can bring them to Hong Kong. Hong Kong is open and willing to let people call Hong Kong home. And that's really important when you have a workforce of both locals and people who are from abroad.
Well, thank you very much, Ken. This is really very encouraging. Now, time is running up, but I cannot let you two go without asking a slightly unorthodox question, because you guys talk a lot about your business, your personal journey. But taking the opportunity of you both on stage, can I ask you both to talk about one thing you really admire both of each other? Admire most of each other. Maybe Larry, you go first.
Larry, we hugged each other to start.
Oh, wait. What I admire about Ken is I've been on panels with him many times, and I've learned quite a bit just listening to his responses to questions. But more importantly, I admired how he built one of the greatest financial services companies in the world. It is amazing to watch how you went from a startup hedge fund to now one of the most iconic hedge funds, but the other business you built, the whole trading platform. And I think Ken early on saw the vitality and necessary, especially after the financial crisis when banks had higher capital standards, that there was a need for more algorithmic trading platforms to assist us. So as ETFs grew, the need for market making to make sure that our clients who were buying ETFs had as low a tracking error as possible. And Citadel is one of the real leaders in this. And so watching Ken, first of all, as a friend, we invested with him, but more importantly now, we use Citadel as one of the major platforms on behalf of BlackRock to making sure that the buyers of iShares ETFs get the lowest tracking error in terms of the bid-ask spread. So, the resiliency of Citadel and Ken himself is is really one of those special things for me to watch. I'm going to be, next year I'll be in finance for 50 years, so it's, I can't say that about too many people.
Okay, can your turn to reciprocate?
Well, thank you. Thank you, Larry, for the kind words. One of the most remarkable stories of BlackRock has been how humble the firm has been as it has become the unequivocal, just extraordinary success story in asset management around the world. I mean, it's incomprehensible, the scale of BlackRock today, managing almost $13 trillion, and the leadership that BlackRock has manifested both in active and in recent decades, truly the leadership in passive investing, which has brought to retirees a far more cost-effective way to save for their golden years. I mean, it transforms the lives of tens of millions of people, the work that BlackRock does each and every day. But one thing that I will say that is remarkable about BlackRock is not just its prowess in asset management, but the remarkable story of Aladdin, which signifies that BlackRock is truly a leader in multiple disciplines, because Aladdin is the platform that powers so much of the world's largest financial institutions, largest sovereign wealth funds, with a technology platform that gives some of the most important players in the financial markets in the world real transparency and visibility into their portfolios, and it allows them to better achieve their investment objectives. So I think BlackRock's just not only a remarkable success story in asset management, but an unstated hero in the technology of finance. And for you to have built the team that's able to conquer 2 summits like that is just a real statement to the talent that you have surrounded yourself and your willingness to empower people to really bring their A game to work each and every day in building the BlackRock success story.
You could get another hug now.
Well, we're really running out of time, and but I think everybody enjoy it. So really thank you, Larry and Ken.
I'll give you that hug.
Thank you very much, Howard, Larry, and Ken. Please now look towards the back for our media friends. Thank you very much. Ladies and gentlemen, as we come to an end of this year's summit, I'd like to take this opportunity to thank you again, our attendees, speakers, and moderators, for making today's a truly fruitful summit. May I now invite Eddie back on stage to say a few closing words. Eddie, please.
Well, I know we're approaching 2:30, so I'll be really brief. I just want to thank all the speakers today for their open and generous sharing on different issues. And I also want to thank you all for participating this morning, for coming to our summit. Do come back next year. We've already set the date for next year. The main summit will be on the 3rd of November, the welcome dinner on the 2nd of November. Mark it in your diary and come back. Thank you very much.
Thank you again, everyone, for joining this year's Investment Summit. We